For those of you that are out there, we're waiting for one Republican member who just walked in the door. So, what I'd like to, Madam Secretary, please call a roll.
Nava?
Here.
Nava here. Gaines?
Here.
Gaines here. Anderson? Evans? Fong?
Here.
Fong here. Fuentes?
President.
Fuentes here. Mendoza? Ruskin?
Here.
Ruskin here. Swanson?
President.
Swanson here. Torres? Torres here. Tran? Quorum.
Quorum having been established, let me extend a welcome to all of you to the Assembly Banking and Finance Committee. We have two bills that will be heard today, and then we'll go into our informational hearing. If I could ask Mr. Fong, who would like to present on AB 1160. And let me take a moment to explain the process by which this bill is being heard in committee past the House of Origin deadline, for those of you who are concerned with those kinds of details. This bill was referred to us last week via Assembly Rule 7.2. When a bill is referred under that rule, the joint rule specifying the legislative deadlines no longer apply, therefore affording us the opportunity to craft and hear a strong bill. Since this bill was last heard in this committee, the author and his staff have conducted several stakeholder meetings to reach a compromise. I want to acknowledge the efforts of the author and his staff in crafting a sensible bill that will protect non-English speaking mortgage borrowers. This will ensure that non-English speakers receive the relevant information they need in order to make the best decision regarding their mortgage loan choices. I know that even with this compromise bill on the table, there are some on both sides of this issue that are concerned that the final forms will be designed for the translation may not include appropriate information, or that may include too much information that would only confuse borrowers. The mock-up currently under consideration provides DOC and DFI direction in designing the forms by pointing to the HUD-mandated good faith estimate form as guidance. This suggestion is permissive in nature to give the department's direction and presumes that the currently proposed GFE will become final January 1 of 2010. I'm confident that both departments can and will design a form that will be useful to borrowers. Again, let me express my gratitude to the author for his work, and perhaps, Mr. Fong, you just want to substitute my remark as your presentation. I'm just kidding.
Sure.
Ask you to go ahead and present your bill, please.
Okay, thank you, Mr. Chair and members. I'd first like to express my gratitude to the Chair and the committee's chief consultant for the inordinate amount of time that he has spent working with my office and all parties interested in this bill. This bill is, in its proposed form, reflects many hours of work, long discussions, and a lot of compromise. There have been some substantial amendments taken to address concerns from the opposition relative to implementation, penalties, and administrative oversight. However, the intent of AB 1160 has not changed. It will provide consumer protections and equity to non-English speakers purchasing a home in California. Specifically, this bill will require mortgage lenders to provide a translated mortgage summary document to a borrower in the language in which the contract was negotiated verbally. As I said before, for most consumers, mortgages are the largest, most complex financial transactions of their lives. For many non-English speakers, failure to translate the documents can result in limited or incorrect understanding of key loan terms like interest rate adjustments and prepayment penalties. Existing law already requires mortgage brokers to provide translated mortgage documents if they negotiate a mortgage loan in Spanish, Chinese, Tagalog, Korean, or Vietnamese. AB 1160 seeks to create uniformity by applying the same requirement to lenders. This bill directs the Department of Corporations and Department of Financial Institutions to create the summary forms lenders will be required to provide. Individuals such as my parents who only speak their native tongue should not be forced to settle and agree to a contract in which they have no written confirmation. AB 1160 is simply a bill of equality. Non-English speakers should have the same rights as those who speak English. Please join me in protecting all the rights of all California consumers. I respectfully request your aye vote. Thank you.
Thank you. I'm assuming you have some witnesses in support?
Yes.
Good afternoon, Mr. Chair and members. Laura Flynn with the Center for Responsible Lending, sponsor of the bill, and I too wish to express my thanks to the author and the staff and the chair and my colleagues who did put so much time on this. And I think the author said all that needs to be said. We are in support. We did share some of the concerns on the reference to the form, but we do also share your belief that the departments will provide the necessary information, and we strongly ask for an aye vote. Thank you.
Thank you. Next witness.
Richard Holliver with the Consumer Federation of California, also in strong support of the bill.
Well, thank you very much. And are there any additional witnesses in support?
Yes, Ronald Coleman on behalf of California Acorn, also in support.
Thank you, sir. Any additional witnesses in support? Any witnesses who are ambivalent?
Thank you.
Mr. Chair and members of the committee, Kevin Gould with California Bankers Association. The mock-up that's been provided to committee appears to be consistent with the structure and the content of the deal that we've reached with the author and the proponents. We hope that and expect that the deal won't deviate from that which we've reached here today. We appreciate the work of the committee, the author and their staff, and the proponents in reaching this compromise. And with the mock-up as presented, we would be removing our opposition.
Thank you.
Margaret Gladstein on behalf of the California Independent Bankers. I too would like to commend the committee staff, the author and his staff, and the sponsors as well. We all worked together to reach a compromise, and with the language as proposed to be amended, the California Independent Bankers will be neutral.
Thank you.
Robert Callahan with the California Chamber of Commerce, and happy to be neutral on the bill.
Thank you.
Melissa M. Lexon with the California Credit Union League, also neutral on the bill, and thank the author, his staff, and the committee staff for their significant work on the bill. Thank you.
All I love, Mr. Fong. How you feeling it?
Pat Zenzela here on behalf of the California Mortgage Bankers Association. The mock-up represents many hours of work on the part of the author's office, committee consultants, the sponsors, and industry representatives. And as it's proposed to be amended, the California Mortgage Bankers Association is neutral on the bill.
Thank you.
Mr. Chair and members, Brian Moss with the California New Car Dealers Association. Thanks to the author and the consultant, by amending a new section, it no longer applies to car dealers and other lenders who already comply with Section 1632 of the Civil Code, and for that reason, we're no longer opposed to the bill.
Thank you very much.
Mr. Chair and members, it's not by coincidence that I'm last. California Financial Services Association, we just got the amendments on Friday. Certainly we appreciate all the efforts of the author and staff and the sponsors of the bill. We still need feedback. My members need feedback on the 3 days from the loan application. In the prior version, actually the discussion focused on 7 days prior to closing, so it's a substantial difference. We're still reviewing that. The other issue is we would appreciate a working group. We understand Department of Corporations has some concerns about that. We think it's a cost-neutral approach to get the stakeholders involved. So that's something we'd like to continue talking about that. Finally, as one of the two groups who worked on last year's 512, all we ask is that if assuming we reach agreement on these two items, that this bill remains intact and unchanged as it works its way through the process once you reach an agreement. So,
Mr. Chairman.
Yes, Mr. Swanson.
This question of the author. So do you also agree that the bill will remain intact and unchanged as it goes through the process?
There won't be any more changes.
All right, well, with that, I move the bill.
Second. There's a motion and a second. Mr. Fong, I think what you've heard people say is they don't want to see a spay-neuter on this. Although that was successful on the Senate side as well. Would you like to close? Any other questions or comments, members of the committee? Yes, Mr. Gaines.
Yeah, just if I could, with due respect, I appreciate you've been working with the financial industry and trying to address some of their issues. I have a philosophical difference on the approach, and my concern is similar to what's transpired in Canada with French versus English, and feel that we ought to be promoting English as our constitutional right in terms of making sure that folks learn how to speak English. And it's, I think, largely been the success of this country in terms of having that assimilation as people immigrate and come to America. And so, as a result of that, I'll be voting in opposition.
Okay. Mr. Fong, ¿quiere responder? I'm sorry, would you care to respond?
Well, it just helps out. It just helps out, and it's just English is our native language, and that's a given. But there are certain people, the immigrants that come over, that don't have the time to learn that language, and they're still stuck in their native language, and those are the people we're trying to help. Yeah. 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 Thank you.
Thank you. Was that your close?
Yeah, I respectfully request an aye vote.
No, seeing no further questions or comments, please call the roll.
Nava?
Aye.
Nava, aye. Gaines? Gaines, no. Anderson? Evans? Fong?
Aye.
Fong, aye. Fuentes? Fuentes, aye. Mendoza? Mendoza, aye. Ruskin? Ruskin, aye. Swanson?
Swanson, aye.
Swanson, aye. Torres? Torres, aye. Tran? Tran, aye.
Yep, your bill is out. Thank you very much.
Thank
and my appreciation to everybody for sitting around the table and investing the time that it took to get this bill to where it was today. Thank you very much. We have a second bill, SB 116. There's been a request that Eileen Newhall be able to present since Senator Calderon is unavailable. There's been a motion and a second. Congratulations on your presentation.
I will be very, very brief. Thank you. I'm Eileen Newhall, staff to Senate Banking, Finance, and Insurance, and I'd like to thank the committee very, very much, as well as the chair, not only for allowing me to present today, but for expediting a hearing on this bill. Senate Bill 116 is sponsored by the State Controller's Office. It's cleanup language to AB 1533, a bill your committee authored in 2007, which was also sponsored by the Controller. Senate Bill 116 will allow the state to sell variable rate revenue anticipation warrants at the lowest possible interest rates the next time our cash flow situation requires us to borrow money across a fiscal year. We're anticipating that that's going to happen as early as this June or July. I've got Rick Chavarro here and with the State Controller's Office and Bill Donovan with Orrick Harrington to testify in support.
Thank you. Any witnesses wish to offer testimony in support? Or do you like the motion and the second that you've already heard?
We support the motion and the second.
Very good. Next witness? Do you agree with that?
Orrick Harrington, the State's Bond Council, supports this bill. Thank you.
Thank you very much. Any questions or comments, members of the committee? Seeing none, please call the roll.
Nava?
Aye.
Nava, aye. Gaines? Aye. Gaines, aye. Anderson? Evans? Fong? Aye. Fong, aye. Fuentes? Aye. Fuentes, aye. Mendoza? Aye. Mendoza, aye. Ruskin? Aye. Ruskin, aye. Swanson?
Swanson, aye.
Swanson, aye. Torres? Aye. Torres, aye. Tran? Aye. Tran, aye.
Thank you, Mr. Chair.
Motion has been granted. Your bill is out. Let me just explain to members of the audience who are present. The Democratic members were good enough to leave the Assembly caucus, who are currently discussing budget issues and budget reform, in order to establish a quorum so that we could move the bills out. So they're not leaving because they're not interested in the subject. It just so happens that the balance of the quorum is downstairs, of the caucus, excuse me, Democratic caucus is downstairs. So let's move on to the next portion of our agenda today, which is the informational hearing regarding accountants. And we've entitled this one Watchdogs Over Watchdogs, as this Banking and Finance Committee seeks to better understand the collapse of the mortgage lending industry. And I have some remarks. This is our second hearing on the collapse of mortgage lending and the role of accountancy, if any. At the last hearing, we heard some allegations about what accountants should be doing as compared to what was actually occurring. The allegations were alarming, to say the least. Today, we will hear from regulators, academics, and the accounting industry. We hope to learn more about how the industry functions and the role of public watchdog. We hope to learn more about how regulators ensure that mortgage lenders are operating appropriately and how regulators ensure that accounting companies are properly working as a watchdog over the mortgage lending industry. I'm confident that what we'll learn today will be enlightening. At our last meeting on this issue, we paid a great deal of attention to the collapse of New Century Financial. Since that meeting, a second mortgage lending giant has been subject to legal sanction. Last Thursday, the Security Exchange Commission filed a civil complaint against Countrywide. The committee's background information that is in the members' binders provides a copy of the complaint against Countrywide in the executive summary of the New Century report by the Bankruptcy Court Examiner. The staff background report also provides a number of news articles and additional background information. This should be helpful today as we discuss this issue. The Countrywide complaint raises significant questions for me today, and I want to ask the panelists to keep the following in mind. The Countrywide complaint makes allegations of various misrepresentations in reports filed. These reports were used by investors to help determine risk and make investment decisions. The complaint further provides that the accounting division was required to assist in the preparation of these reports. Additionally, the complaint asserts that New Century's risk officer sounded the alarm several times, that there were problems that needed to be corrected. Therefore, it seems to me that management, accounting, and senior staff all may have known that there were significant misrepresentations in these federally required reports. Therefore, this begs the question of what the external auditor did or did not know, and what they did or did not do in their role as watchdog. I don't expect people today to know the answer to that question, or actually those two questions. However, I would like the panelists today to keep this in the front of your minds as we discuss the issue more broadly. If the allegations are true, what should the auditor have known, and what should the auditor have done? California was the flashpoint in the economic collapse worldwide. What happened at New Century, Countrywide, and elsewhere in mortgage lending cannot happen again. We need to learn as much as we can about this and act accordingly to prevent such reoccurrence. These hearings will be helpful in that effort. I ask each panelist to make a brief presentation, and then we'll open up the panel to Q&A from the members of the committee who are no longer here. I would encourage a dialogue between myself and the panelists. I'd like to structure this so that each panel would take about 45 minutes. Having said that, if we can please have our first panel, which is entitled, What are the Causes of the Collapse of the Mortgage Lending Industry? I believe there's Andrew Atkinson, who's a professor of finance and economics at UCLA, Dana Basney, CPA, Mayer Hoffman McCann, PC Director, CBIZ, Accounting Tax Advisory Services in San Diego. Welcome, John.
Well, hello. I'm Andy Atkinson. I'm the Stanley M. Zimmerman Professor of Economics and Finance in the Department of Economics at UCLA. I'm also the director of our Business Economics program, which is where most of our undergrads who are interested in careers in business come get educated. I've been teaching for about 20 years at a variety of universities, including University of Chicago, University of Pennsylvania, University of Minnesota. I've been on the staff as an economist at the Federal Reserve Bank of Minneapolis and been a consultant there after that for about 10 years. And I frequently give talks and visit various Federal Reserve banks and the Federal Reserve Board of Governors. And what I'm prepared to talk about today as an economist, and primarily as an academic economist, are what are the economic forces that have led to this particular collapse of the mortgage lending industry. And I'd like to just put out the list of questions that I feel that I'm prepared to talk about, and then as we have the dialogue, we can go in depth where you feel it's more helpful. So I'm prepared to talk about how did we get to where we are today. To put a focus on subprime lending, a big question is, why did we have this big relaxation in underwriting standards in subprime lending when we did, which was basically the mid-2000s? Why did we have investors invest in those subprime loans when they were sold into the market? These are very sophisticated investors who were buying up the loans. Why did they do that? When we look at the mortgage problem more broadly, is it a subprime problem or is it a broader problem of mortgages, the whole mortgage market? There has been a bunch of research, primarily within the Federal Reserve System, that asks the question, is this default crisis driven by that relaxation of underwriting standards, or is it driven by the economic events that have occurred, the collapse of housing prices and unemployment? And then finally, there's also a bunch of research that asks the question, did the lenders and the investors in these mortgages know the risks, or should they have known the risks? Did they have the information to know the risks? And so I can speak a bit about how is the market set up to put the information out there for investors to figure out what the risks are. And then I'm also prepared to talk about two issues that would be direct to California in terms of thinking about the regulatory response. Basically, for this legislature, obviously there's a slew of national and international issues connecting to banking regulation, regulation of finance more broadly, but there's two direct issues that I think come right here to the state legislature. One is How should California deal with this immediate foreclosure crisis? You have about nearly 2 million homeowners who are now in a position where their mortgages are, the principal balance on their mortgages exceeds the value of their homes. And so all of those homeowners are at risk of foreclosure. And then the second issue is going forward in the area of consumer protection. That is an area that would fall clearly under the responsibility here of the state government, and kind of what went on there and what could be done going forward. So that's kind of the menu of what I'm prepared to talk about. I would like to say at the start, though, because you've raised the issue of accounting, I mean, I've looked at quite a lot of studies by academics and policymakers at the federal level of what are the sources of the crisis and what are the required reforms. And I have to say, from my examination of everything on the issue, I haven't seen anyone point to the accounting industry as having a substantive role in this crisis. You raise questions about, or one can raise questions about, were audits done properly and the rest of that, but in terms of having a material impact on the outcome, I haven't seen anybody say that the accounting profession played a big role there. I think to kind of summarize how we got to where we are today, I think it's important to remember that this is the second collapse of the mortgage lending industry in our memory. The first one was, of course, the collapse of the savings and loan industry. Why is this relevant to think about it that way? Well, I think you want to think that there's two big economic risks in mortgage lending. There's risk that interest rates will change. So if you've made somebody a 30-year loan at a fixed interest rate, and then interest rates go up, you as the lender or investor effectively have to take a loss on the loan. That's what basically happened in the savings and loan crisis. Then in the 1970s, long-term interest rates rose dramatically. That wiped the industry out. The other big risk is that house prices change. And so we had a period of, say, 40 years of pretty stable house prices. And then we had, in the early part of this decade through about 2006, just an explosion in house prices, not just in California, and not even just nationwide, but actually worldwide. Great many countries had this boom in house prices. And now we've had, particularly in California, a very large collapse, and that's fundamentally the force that's driving the collapse of the mortgage lending industry. The industry, the regulation of the industry, the risk assessment in the industry failed, every dimension of that failed to confront that risk. And if you want to think about what to do going forward, you're going to need to think about a change in the structuring of the industry to deal with this risk. So after the savings and loan crisis, there was a big restructuring of mortgage lending. You basically brought in securitization. That business model originated in the 1980s under the sponsorship of what they call the government-sponsored enterprises, Fannie Mae, Freddie Mac. And then it spread more recently to private mortgage-backed securities, which is where people point the finger in the subprime crisis. That's where the subprime mortgages got sold. But to give you a sense of kind of relative size, there's roughly $11 trillion of mortgages in the United States, of residential mortgages in the United States. About $5 trillion are packaged into the GSE mortgage-backed securities, and those are all the conforming loans, what we call the prime loans. As you might be aware, Fannie Mae and Freddie Mac have also collapsed and are under Treasury receivership. There was about $1.5 trillion of privately issued mortgage-backed securities. This was particularly relevant for California for two reasons. That includes the subprime loans, a lot of which were in California. The other reason is house prices historically have been very high in California, so many California homebuyers could not get what's called a conforming loan because the limit on the size of a loan you could get from Fannie Mae or that would be insured by Fannie Mae or Freddie Mac was too low for most Californians. So all those loans, when they got securitized, also went into that $1.4 trillion pool that we would talk about. But we're basically talking then that 10 to 15% of the total mortgages in the United States are in these privately issued mortgage-backed securities. And the reason I want to emphasize that is I don't think, this is not a case of the tail wagging the dog. we're not going to have something wrong with the market for 10 or 15% of the mortgages in the United States driving a housing boom and a housing bust and an economic recession. The cause and effect links there just don't make sense. Okay, so I'd like to say that the fundamental cause and effect links are we had a boom in house prices, up 40, 50% nationwide, and then a subsequent fall that has been rather large, particularly in California. And as a result of that, you have a great many homeowners who are in a position that if they want to move, I mean, there's the issues of homeowners who are unemployed in this recession, and that's, of course, an issue if you're dealing with people who, say, have temporary financial hardship and then can't make their payments. But then there's the issue of all these people in the normal functioning of the economy move from one house to another, move from one job to another. When they go to try to sell their house now, they can see quite clearly that the sale price is not going to cover the principal on their mortgage. And they're then left with a choice of, if I want to move to that job over there, I'm going to have to default. I'm going to have to basically put myself up into foreclosure. And that, I think, is the fundamental crisis, the immediate crisis that's facing California. So the thing I want to emphasize for you in terms of thinking about this problem and give you a sense of the scale is overall about 30% of the homeowners in California have negative equity now. And if you go to certain areas, for instance, in Merced or Stockton or Modesto, these inland areas, we have over 50% of the homeowners are what they call underwater. So basically anyone in those areas who thinks about moving for one reason or another is going to be in a very difficult position pulling that off without going into foreclosure.
Have you any information that quantifies the sorts of percentage or numbers of people that are looking at having to make a move or wanting to make a move that are, you've got 40 to 50% of the homes that have negative value. And so that if there's an opportunity for them to go somewhere, then they have a problem that goes into foreclosure because they can't sell the house and cover the note. Do we have any idea how many people that applies to?
I can tell you this qualitative figure because I don't have the quantitative one on the top of my head. So you can track what's called state-to-state mobility by following IRS tax returns. And you may have seen news articles saying state-to-state movements have fallen to the lowest level since 1945. And when you think about the fact that the population of the United States has grown considerably since 1945, that's really a shocking figure. So there is a tremendous sense that this crisis is impairing the normal functioning of the job market, which normally requires people to move from one place to another as they switch jobs. All right, so
let me ask you, do you have any information historically how long people have remained in a home? Because I remember hearing, I thought at one time it was an average of 7 years.
Yes, I think that's roughly right. Is that the same? I think that's roughly right, yes. Typically, I think what you find is if you thought you weren't going to stay in a home for 7 years, you look to rent. That would be the normal pattern, just because the closing costs and the rest of it would mean it wouldn't make sense to stay put.
Okay, thank you.
Another figure that I want to emphasize is that this foreclosure process is now beginning, and so we did have a housing boom and bust locally in California in the early part of the 1990s, the late 1980s and early part of the 1990s. Particularly in Southern California, there was a pretty significant housing price boom and then bust. And you did see during that time period quite a large number of foreclosures. And so in the middle part of the 1990s, you set what was then the record for what are called notices of default, which is the first step in the foreclosure process. So we had about 150,000 notices of default filed in 1996. Now I want to emphasize that because if we use that lag between the house price collapse that occurred in 1990, 91, maybe 92 in Southern California, and how long it took to work out this process of foreclosures, that's a 4 or 5 year lag. So if we use that to look forward as to what will happen in California now, it's not a pretty picture. Okay. Now, if you look at what's been going on, so we broke that record in 2007. I think over 200,000 notices of default were filed, and then in 2008, over 400,000 notices of default were filed. Now, the reason I'm focusing on notices of default rather than foreclosures is, I mean, for instance, we've had a foreclosure moratorium here, so there's the numbers on foreclosures can vary as the state policy towards permitting foreclosures varies.
Before, let me interrupt you, and I apologize. I have to. I've been called down to which committee? Okay. I'm gonna. I regret this, but since I can't hand the gavel over to the vice chair, I have to go to a committee. I should be back in 10 minutes. This is not the way I want to do this, but if I don't go down to this committee, then I lose a bill. So let's take a 10-minute recess.
Yeah, that's what they say. Yeah, they were using the example that you had only 25 people for 4,000.
We actually
Can everybody take their seats again, please?
Thank you. I apologize for the interruption, but I think I made it back in 8 minutes. So if you'd be so kind as to continue.
All right, so I think what I'd like to do to kind of wrap up is just give you a sense of what were the mechanisms through which investors would assess the risks involved in making these investments, and then kind of what are the California-specific regulatory issues that I would see. So basically, the way it worked both in the subprime industry and in the prime mortgage industry is that somebody would originate the loans, package them, put them in a separate entity that would be where you legally organize the mortgage-backed security. That entity would have a trustee that would release data, basically computerized data, from what was in the original loan files. And then as you service those loans over time, you report the data on how the loans were doing. So this data source would typically get aggregated by, there's two companies that lead that data aggregation, First American CoreLogic and Lender Processing Services. And so basically everyone in the industry, the credit rating agencies, that'd be Standard & Poor's and Moody's, and then the larger investors would purchase this data and look at the data to say, well, if I've got loans that have, full documentation and loan-to-value ratios of 80% at origination and this or that FICO score, what do we see as the default rates? And if we've got loans that don't have documentation and much lower FICO scores and much higher loan-to-value ratios, what happens to those? And so people were building essentially econometric models to estimate those risks. And on the basis of those models, the credit rating agencies would then issue the ratings, the AAA rating or whatever, to the various securities that were being sold. So in terms of who was in, a lot of people have pointed to the credit rating agencies as the watchdog, at least within the private market, that failed. And then, of course, there were various failures at the regulatory level as well. Now, my own view on that is, yes, they certainly did fail, and I can cite some research examining what people, going back and looking at those econometric models, what should you have known at the time? And there's a bit of a debate about how much people should have known, focusing on the primary risk being the change in house prices. But I think and there's, a view that maybe they should have known more, maybe not. But the focus is very much on the credit rating agencies as being the institution that failed, that they went ahead and gave the AAA ratings when they didn't necessarily have a sound justification for doing that. And I'm not an accountant, but my understanding is that the standards for a credit rating are different than the standards that you would get in an accounting statement, because a credit rating is supposed to, when you rate a bond AAA, it's supposed to survive a stress test. Mm-hmm. Okay, whereas an accounting statement will just put a value on something at a particular point in time. Mm-hmm. And so there is still the question, though, that the investors who were relying on those credit ratings were very sophisticated. And I mean, if you talk to people who are at PIMCO, BlackRock, Fortress, these other major investors in these securities, they are spending millions of dollars a year buying these data and doing their own studies. So, they can't say I'm some mom and pop shop that got deceived. I was looking at they were looking at the data just the same as everyone else and making their investment decisions based on that. Okay. Now, if I turn to issues kind of in California, I think unwinding this crisis is going to be a huge, one of the huge policy issues of our time, in the sense of you've had this big drop in house values. I think a number of like $1.2 trillion drop in the value of housing in California last year, somebody has to take that loss. It has to be the homeowner or the investor. And how that loss gets divided will be shaped by, to a large part, by California's attitude towards foreclosures. The investors are clearly going to be pressing to get as much money out of this as they can get. The homeowners are, not particularly organized, don't necessarily have anyone, any large entity looking out for their interests. But that bargain over how are we going to divide this loss is really going to be at the center of unwinding this crisis. The other area that I think is specific to California is that, and I guess we'll hear about this later in the hearing, lenders like Countrywide, New Century, the other subprime lenders, were not banks, so they didn't fall under federal regulation. They fell under regulation here in California in the Department of Corporations. And there's a matter of resources, and there was a statistic from a Wall Street Journal article that back in the subprime boom, the Department of Corporations had 25 examiners for 4,800 institutions that they were supposed to be regulating, and that a comparable statistics would be Wells Fargo had 34 examiners dedicated just to it from the Office of the Comptroller of the Currency, and then would have on top of that, say, another 20 examiners coming in from the Federal Reserve. So the extent of the resources available to look out for the consumer when these mortgages were originated were just way out of line. Comparing the federal level and what was going on and at the state level. Okay.
Let me ask you a couple of questions, and then I'm going to open the roll so that Mr. Anderson can add on. But in terms of your area, economic forces, when you have a company who wants to position itself as a solid company so that it attracts capital, so that it can then turn around and lend it out, because you're not successful unless you're able to attract the money that you then turn around and lend out. And you take your fees and you take your interest and you take whatever it is. Wouldn't you say that the soundness of that company, however it's measured and evaluated, is an important element as an enticement for additional investment?
There's a specific circumstance here that I think needs to be taken into account. When you sell a pool of loans, you're selling with that, you're providing with that the information that was in the original loan files.
Mm-hmm.
So you can stand up in public and say, I'm selling apples, but any investor who bothers to look at the data you're releasing about your loan files can see you're selling oranges. And so I think that I guess it's possible that they falsified the loan files. I have no evidence of that, but that's, but
I'm not suggesting that.
But the safeguards are basically in this data collection that was required when you packaged these securities and sold them. You had this separate, direct method of, the investors could see what was going on, what's being sold. And then the debate is really, what's going to happen to these mortgages? I have not seen evidence that the loan originators had better information about the likelihood these loans would be repaid than anybody else had. I think they were just happy to process as many of these things as they could.
For these kinds of companies that were involved in selling the pool of loans, was there any relationship between reserves and whether or not they were assessed or considered to be a sound company?
Okay, there's a specific issue in that as an attempt to limit the worst behavior, there would be a requirement that if a loan went into default within a very short time period after you originated it, most frequently 90 days, but depending on exactly the contract you made when you sold the loan, there would be could be longer, could be shorter. You were asked to set aside reserves to buy those back. I don't see that as being central to this problem. It's a very small part of an overall problem. That it's not as if the subprime crisis was caused by a bunch of loans that defaulted in the first 90 days. It's going on at a horizon that's significantly longer than that, and it's really a problem of nobody seems to have taken into account what would happen if house prices fell. When I say nobody, the investors didn't really, and to a certain extent, the home borrowers didn't either. But I have to admit, in my own experience, watching my house climb in value in 2004 and 2005, I got excited and thought, oh, I'll pay for my kids' college education and all kinds of things off of my home equity. And now, obviously, I have to reassess that. But and I'm a PhD, so the regular homeowner watching the home equity rise may have felt, oh, this is an opportunity, naturally felt this is an opportunity to pay for all kinds of things that have some merit.
Okay. Just a moment before. This is Mr. Bassney, correct?
Yes, sir.
You just give me one moment. Let's open the roll so that Mr. Anderson can add on.
AB 1160, Anderson.
No.
Anderson, no.
Remind me, why did I open the roll? I'm sorry, go ahead.
SB 116, Anderson. Anderson, aye.
Well, 50% is better than...
This is right. It's not a whole strikeout. Thank you very much.
Thank you.
Mr. Bassney, welcome and thank you.
Thank you, Your Honor. Let me introduce myself briefly. In addition to being a CPA at 36 years in public accounting, I've taught a variety of accounting classes since 1978. Since 1982, I've taught advanced accounting, managerial accounting, ethics, and professional conduct for CPAs at the University of California, San Diego. At current, I teach fraud examination and forensic accounting at the University of San Diego in its graduate program. I'd like to begin my testimony today by reviewing the historical background of the current economic problems we face. I'll then discuss the role of the accounting profession as it relates to those problems. In the 1970s, the inner cities of our country were deteriorating, with most of the middle class fleeing to the suburbs. Because these areas were deteriorating, banks were hesitant to loan money to residents in such areas. To halt the deterioration of these areas, the government, both with national and local levels, tried to address this lack of private capital by funding massive urban renewal projects in which whole blocks were purchased and then resold to developers. For example, in San Diego, we had a major redevelopment area where our downtown area, which had consisted of a bunch of shady bars and adult businesses, was converted into a delightful family place called the Gas Lamp as a result of these projects. These projects and these programs were, for the most part, quite successful, and our inner cities did see a resurgence. Extending this one step further, under President Carter, the government initiated further programs to halt the deterioration of urban areas by encouraging private capital and preventing redlining. The government instituted programs to combat redlining and encouraged banks to loan to a certain percentage of their assets to non-conforming borrowers who might not otherwise qualify. The intention of these programs was to allow private individuals access to mortgage money to improve, buy, and renovate personal property in poorer neighborhoods. This was a well-intentioned program and at first met with considerable success. It was later expanded under President Clinton and has more or less continued through the current crisis. Study after study has shown that the largest single asset that most individuals have upon retirement is equity in their home. The encouragement of home ownership is a good thing, and there were beneficial results from these programs. These programs, combined with ever-decreasing interest rates and ever-decreasing down payments, resulted in home ownership reaching a record high of 69% for all Americans immediately prior to the collapse of our mortgage markets, which was up from the 64% just a few years before. At first, banks and lending institutions were strongly opposed to accepting these non-conforming loans, since all business institutions do not like to expose their assets to financial risk and will usually try to reduce the risk if possible. Lending institutions soon learned, however, that these loans could be packaged with other good loans and resold on a bulk basis to Fannie Mae and other mortgage brokerage houses. The brokerage houses in turn created a series of derivative instruments such as mortgage-backed securities and other collateralized mortgage obligations, which were then sold to investors in the U.S. and abroad. In order to reduce their risk in buying these investments, investors increasingly require them to be insured. Large insurance companies such as AIG added another layer of protection to the investments by insuring such derivative instruments from loss. In turn, each sector of the chain made money and felt that they had passed the risk on to the next link of the chain. The insurance companies felt secure as we had had a 10-year increase in housing prices and saw no end in sight to such increases. Lenders who had once opposed the government's program that imposed loans with less than ideal borrowers upon them began to see such loans as a money-making opportunity because of the perception that risk could be eliminated by passing it on to the next financial company in line. As a result, underwriting standards became increasingly relaxed, and eventually there was a lack of proper underwriting procedures. In some cases, underwriting department standards were overwritten by management. In effect, the industry was run by the bigger fool theory, which said basically, it doesn't matter if we have a good loan, we will be able to sell it and our money will come out of it very shortly. The next guy in line will have all the risk. This goes through several intermediaries. Mortgages are sold, mortgages are then packaged and resold as collateralized mortgage obligations and derivative instruments. Among the relaxed underwriting standards was the extension of 100% financing, or the 80-20 financing, where one lender would assume the entire risk of the 100% value of the property. This eliminated the need for second trust deeds. In prior downturns, such as the one that occurred in the early 90s, the second trust deed market was basically wiped out. Our core lenders survived that because they were not subject to the top 20% of risk. With these loosened standards now, they were at risk from day one. To loan 100% value on real estate market that has been increasing for 10 years steadily and has not seen a downturn since 1995 was clearly, in hindsight, and I believe in foresight, a very, very poor business practice. All these factors may be summarized as loose credit policies, cheap money, which when added to the feeling of security brought about by the multiple resales and repackaging of the deficient loans, led to the continuation of unsound lending practices, which there were some positive effects. As I say, home ownership went to a record level. However, as we now know, there were far more negative effects. These practices pushed housing prices to unsustainable levels. Prices at the median home went from the traditional 3 times the median family income to 4 times the median family income, which was a level that was unsustainable. When housing prices began to decline, buyers of these derivative instruments were no longer able to resell them. The market became illiquid, and the whole house of cards collapsed very quickly upon itself. What then was the role of the accounting profession and the mark-to-market accounting principles in this debacle? Auditors, I must emphasize, are not members of management. Auditors are required to be independent and not make management decisions. The public accounting profession was not responsible for the underlying cause of the market collapse. It certainly did not set government policy which promoted subprime lending, and it had no role in the packaging and resale of mortgage investments. In addition, it does not set underwriting policies either at the governmental or at the company level. In fact, auditors are specifically prohibited from making any management decisions for the companies they audit. The primary criticism voiced against the accountants and auditors is a failure to warn the public of the pending crash and to ensure that reserves were set up sufficiently high to recognize the risk inherent in the subprime market loan portfolios. In the cases which I am personally familiar, evidence of the market turning became apparent over a relatively short period of a few months. Due to the rapid loss of liquidity accompanied by the decline in the real estate market, when the bubble burst, the fact that auditors typically only do annual audits, many of the companies showed sudden and significant losses at the risk that had been passed on, as the risk that had been passed on the system came home to the entire industry. Market forces were the primary cause of the decline in these companies, which were ultimately dependent on real estate market that had collapsed after it was pushed to unsustainable levels. As a result, even last November, as can be seen even last November in the stock market, markets can respond very rapidly and dramatically. I, like millions of Americans, did not predict the recent November downturn and saw almost 40% of my retirement investments, which my wife and I have saved for over our entire lifetime, disappear, at least temporarily, in a few weeks. As my own experience has shown, having a CPA certificate does not give one the psychic abilities to project future market events. Accountants do not and cannot make management decisions for audit clients. In addition, under the new Sarbanes-Oxley legislation, accountants cannot perform consulting work for public companies under which they do audits. The auditor's role is to express an opinion on the company's financial statements as presented fairly in accordance with generally accepted accounting principles. As such, we examine historical transactions on a test basis. As auditors, we are not prognosticators of market fluctuations, nor can we prevent companies from failing. Even if all companies use the best of accounting principles and are completely open in their disclosures, a certain percentage of them will fail due to market fluctuations, and certain industries will thrive and others will not. As I stated earlier, the public accounting profession is not responsible for the underlying cause of the market collapse. The profession certainly did not set government policy which promoted subprime lending. It had no role in the repackaging and resale of mortgage investments, and it does not set underwriting policies either at the government or the company level. The role of fair market value accounting or mark-to-market accounting has been questioned as a cause for the mortgage debacle. These questions were raised by well-intentioned individuals who are not knowledgeable as to the accounting principles involved, as well as by regulators who are looking for scapegoats for their own lack of oversight, and by plaintiffs' lawyers looking to further their own economic interest. Fair value accounting is a concept widely embraced in international accounting standards and by users of financial statements and information. U.S. standards are soon going to be merging and adopting international standards, and mark-to-market accounting will become the rule worldwide, or is the rule basically worldwide now. Mark-to-market accounting has some benefits and some detriments. Proponents claim that representing assets such as loan portfolios at fair market value is a better reflection of a company's actual value. Critics say there are three major problems with fair value accounting. One, markets fluctuate and changes can be temporary, whereas they may not really affect the value of the assets in the long run. Such changes can also occur rapidly. Market fluctuations reflecting fluctuations may result in such volatility that the long-term value may not be the same as present market value. Valuations of financial assets themselves proves to be presenting unique problems. Some valuations are relatively easy to perform when securities of investments are publicly traded in an active market because one can use the current market price of an actual exchange. However, valuations are more imprecise, and significant estimates are often involved when securities or investments have no market. It involves quantifying both risk and return, which is certainly not an easy or a totally objective job in determining as historical cost was. I myself am not an advocate of mark-to-market accounting because I feel it lacks the objectivity and verifiability of using historical cost, even though proponents say it might be more meaningful. I have advocated using historical costs for financial statements solely and adding an appraisal reflecting market values as an additional financial statement. I should emphasize, however, that the trend to market accounting has worldwide acceptance, and despite my personal reservations, the accounting standards of this country will be moving even more in the direction of international accounting standards. This is a nationwide and a worldwide trend that will certainly continue. Any action by a single state to reject this trend and set standards that differ from the rest of the world would only result in economic chaos for that state. Furthermore, I want to emphasize that mark-to-market accounting had no role in the creation of the loose credit policies and cheap money policies, which, when added to the feeling of security brought about by the multiple resales and repackaging of the deficient loans, led to the current crisis. The only thing mark-to-market accounting required was that assets be reported at their current values. This is not only my opinion, it is the opinion of the Securities and Exchange Commission, which prepared an exhaustive 259-page study of the role of market-to-market accounting and the accounting profession as it relates to the present collapse of some of our financial institutions. The Office of the Chief Accountant of the United States Securities and Exchange Commission prepared its report at the request of the United States Congress. The Securities and Exchange Commission is certainly very well qualified to make such a study, and it employs some of the finest accounting and legal minds in the nation. The primary purpose of the SEC study was to study the effects of mark-to-market and fair value accounting and the impact it had on the current banking and mortgage crisis. This study is entitled Report and Recommendation pursuant to Section 133 of the Emergency Economic Stabilization Act of 2008, Study on Mark-to-Market Accounting. This study, which is 259 pages long, discusses in some detail the causes of many of the major bank failures. It is available on the Internet, and I would urge members of this committee to read this study because, in my opinion, it is by far the most comprehensive and the best and the most unbiased study of the role of accounting and accounting principles in the current debacle. The study should be compulsory reading for anybody who truly wants to understand the role of accounting principles played in the recent financial turndown. The SEC, while pointing out the need of some improvements in the application of mark-to-market accounting, recommended that existing fair value and mark-to-market requirements should not be suspended. The study goes into further detail than I can possibly do today regarding the failure of Washington Mutual, IndyMac, Downey Savings and Loan, and other failed lending institutions. Nowhere in the study does the SEC opine that accounting irregularities or accounting principles had a significant causal effect on the failure of these institutions. On page 4 of the study, the SEC opines, bank failures in the U.S. appear to be the result of growing probable credit losses, concerns about asset quality, and in certain cases, eroding lender and investor confidence. For the failed banks, which did recognize sizable fair market value losses, and not all of them were using mark-to-market, it does not appear that the reporting of those losses was the reason the bank failed. One must also be aware that banks and financial institutions are not only audited by independent auditors from the public accounting profession, they are also audited by federal and state regulatory agencies on a regular basis. If the independent auditors from the public accounting profession were not properly performing their audits and were in collusion with their clients, as has been implied by some plaintiffs' lawyers pursuing their own financial interest, one would expect glaring discrepancies between the financial conclusions reached by the public accounting profession and the government auditors. I am unaware that such discrepancies were widespread, and I am not aware of any such discrepancies being reported, certainly not to any significant degree. I believe the SEC study is the best source of information available about the role the accounting profession played in the economic downturn. It's objective and it's unbiased. I'd also like to talk a little bit about the Madoff scam. The Madoff scam has been taken to present by those whose interest it is to present such views that the public accounting profession is not doing its job, and here's just another example. I think it almost proves the opposite. If you look at the accounting firm that was doing the accounting for the Madoff firm, it was a single individual, period, not even two CPAs in the firm. And that simply tells you that Mr. Madoff could not get any reputable firm, any firm with any prestige, or any firm more than one member to justify his improper activities. Our profession is certainly not perfect because we employ human beings, and human beings by their very nature are fallible. The criminal or grossly negligent activity of a single individual who is clearly acting outside the norms of the profession should not be blown out of proportion and represented to be typical of the profession as a whole. I'd like to focus also on the current enforcement activities. I recently gave testimony in a case involving a CPA who was subject to discipline by the State Board of Accountancy. I know that this agency is conscientiously monitoring our profession, which I both welcome and commend. Nobody, but nobody, wants bad apples out of the profession more than the profession itself. While I do not believe that any new legislation is needed to regulate the accounting profession, I do believe that the legislature should adequately fund the existing enforcement activities of the State Board of Accountancy, ensure that they have the resources to bring discipline to bear where it is appropriate. I believe that they are in need of additional staffing, and I would urge this committee to make recommendations to the legislature to give them the money to fund it. In conclusion, let me state that I'm proud to be a member of the public accounting profession. I'm even prouder that my youngest son is a CPA as well. The profession has enacted continuing education requirements which significantly exceed those of the legal profession, the medical profession, or any other profession of which I am aware, and I'm proud to be a part of those educational processes. I believe that the overwhelming majority of the members of the profession work diligently to live up to their professional responsibilities, and that neither the public accounting profession nor the use of mark-to-market accounting was a significant factor in the current economic debacle.
Thank you for that presentation. In trying to understand the role of the accountant as an auditor. Am I correct that if you are an auditor or accountant and you uncover information with respect to the company that causes you to think that they're deliberately misrepresenting the value of their assets, that the option that you have as the accountant is to withdraw?
It's not that simple.
Okay.
It depends on the audit. In most audits where you are doing a regulatory audit for HUD or for a government agency or a government grant, those agencies have specific audit manuals that you must follow. In those audit manuals, for almost all of them that I am aware of, there is a requirement that if the accountant not only becomes aware of fraud, but also only becomes aware of the possibility or the existence of fraud, he has the responsibility to notify the appropriate regulatory agency under the audit rules for that agency. I myself have done that in the course of my profession.
What agency did you notify?
What's HUD.
Okay. Now, for publicly owned companies, we're not talking about like with HUD, but for privately owned companies that essentially want to go out to the market and obtain investor money to grow so they have more resources, how does that compare to your experience with the regulatory agencies where you have an obligation to notify the regulatory agency? What option does the auditor have then when they're retained by a publicly traded company to review the books?
Well, when the auditor has a number of options, and they vary depending on the circumstances. But let's say first, and what happens in almost all of the cases that I've been aware of, when the auditor does not agree with the accounting treatment that is done by management, the auditor goes to the audit committees. Under Sarbanes-Oxley, we have independent audit committees, or should have, that are supposed to given the task of overseeing management. And so they go to the audit committee, and we would typically explain to the audit committee that we do not agree with the accounting treatment of whatever the issue was, and the audit committee would enforce it. If the audit committee did not come to our point of view and chose to, they then have two choices. They can basically fire us, or we can resign. If we resign, there is a reporting requirement with the SEC that when accountants leave an audit, they have to report on an 8K as to any accounting discrepancies that they have with the management. So the appropriate recourse at that point would be to file an 8K. Management has to file the 8K as a matter of law whenever an auditor is replaced. And in that, management would state that typically there are no discrepancies with the accountants, or there are disagreements with the accountants. The accountants then are given that document and have a very short period of time, I think it's 4 days or something, to respond to it, giving their side of the story. And I have also filed things with the SEC where I have stated that I withdrew because of questions about the integrity of management. And the case I had, we weren't certain to the extent fraud existed, but we had evidence that management was not being truthful. And at that point, we decided that we did not want to be associated with them. We filed the appropriate 8K and withdrew.
And where are the 8Ks retained? Who has custody of those?
That's a public document. It's available on Edgar. It's filed with the SEC. The SEC also has broad investigation powers to come in and review accounting firms. They do a review of public filers. I believe we're reviewed every year by the Public Companies Accounting Oversight Board. That board will come in and will at random pick some of the audits we did. We'll give them a list of all of, well, they have a list of all of our filers. They will at random pick some of those and review our files, and they will make recommendations if something is incorrect, and they have the power and the ability to bring sanctions to bear on firms not complying properly with the requirements of a proper audit. And I welcome that oversight. I think it's a good thing.
When you were pretty clear that you don't think that there's any other legislation at the state level that would be required, just essentially provide the resources to the regulators.
I think that's the problem that we have. I don't think it's a problem. I don't see this current crisis in the same picture as perhaps Enron, I believe, was a different situation. Here, the current crisis is I don't see that the accountants were involved and collusive or in any way promoted that would happen. What happened in reality, at least in the experience in the cases I have, was that the market turned very quickly. And typically, and it's very difficult to generalize, but I'm only speaking now from my experience, and be aware there are many different forms of these derivatives, and I certainly don't profess to have seen all of them. The ones I have seen typically have a 90-day sort of buyback period, where if you sell it to the next chain in line, typically in 90 days, they had the right to review those portfolios and kick back to the initial mortgage company those loans that were non-performing or not meeting their criteria. So the problem you had is basically these mortgages were created and they were traded within 90 days, and then from the viewpoint of the originating company, their risk was gone after 90 days. So they didn't have a huge buildup of risk until the market turned. And when the market turned, it was basically a liquidity problem. The market turned very quickly, and these mortgages that built up could not be sold. And in addition, at the same time the market turned, the real estate market collapsed. And the problem, as my colleague to the left of me has pointed out, was not just a problem of subprime lending. It was a problem of the entire real estate market being overinflated and just the values of real estate being at unsustainable levels. And I think that what happened here is, in the cases I saw, the actual decline occurred in the interim between audits. You had a December audit for one year and a December audit for the other year by the outside accountants, and the declines tend to happen in the ones I'm seeing in the middle of the year. So it wasn't so much a problem of improper reporting by the public accounting profession. I think it was a problem of a dramatic change in the market that would not be foreseeable looking at the year's prior audit.
You want some to add something?
Well, it just... when he's talking about the market turning, I think to be specific, the market that at least alarmed the Fed the most was the credit market. And it was, if you measure the spread between what's called the London Interbank Offer Rate, say the 3-month LIBOR, and say an equivalent Treasury bill or the federal funds rate, it's often called the TED spread, that jumped in the course of about a week from being about 10 basis points to about 100 basis points in August of 2007. And that set off alarm bells among central banks worldwide, because this is a spread that stays traditionally down around 10 basis points. And when it jumped, they were pretty scared about what was going to happen. And that's when you see the Fed responding by starting to cut the federal funds rate. Then in the spring, it actually took a while for it. That's often a signal that they're worried some major institution's going to go down. It didn't happen to the spring when you had Bear Stearns go down, and then you had Lehman Brothers go down. And then in September of 2008, it went to 400-500 basis points. And that's when everything completely froze up. But everybody who was in this game of we're going to make money based on we can roll over our financing, whether it be short-term financing or we can sell these things on to somebody else, got caught. The music stopped basically in August of 2007 when that spread went up. And then, the whole thing, the whole worldwide credit market came crashing down in September of 2008, and we now have this worldwide recession that's following from that. But that's the specific market. The housing market, it's always hard to tell exactly when it turns because how do you measure it, all the rest of it.
Good. Do you have any remarks in conclusion for this panel?
Just one thing I'd like to say, sir, is I've seen a lot of presentations to this committee which constituted basically plaintiffs' lawsuits and causes of action in litigation that has not been concluded. I believe I have been named as an expert witness in literally hundreds of cases. I'm very familiar with the litigation process, and I would caution you to take as truth everything you see in a complaint. I think the SEC study is far more objective and is, I think, the most unbiased study that exists in the area of the accountant's role and accounting principals' roles in this. And I would urge you strongly to review that, because I really do believe that that is a far less biased and a far more appropriate source of reference.
Thank you. So noted. Thank you for your contribution. We have the second panel. How have state and federal regulators and the accounting profession acted to protect the public in the collapse of mortgage lending industry and the financial marketplace? Mr. Peterson, Mr. Dufouchard, and Mr. Lacey. Welcome.
Thank you.
Mr. Peterson?
Yes, thank you, sir. Good afternoon. My name is Robert Peterson. I am president of the California Board of Accountancy. I would like to thank the distinguished chair, Assemblyman Nava, for the opportunity to appear before you today to discuss the role of our Board of Accountancy. The question you have asked is, how have we, the California Board of Accountancy, acted to protect the public in the collapse of the mortgage lending industry and the financial marketplace? The California Board of Accountancy licenses and regulates approximately 81,000 individuals and firms in California. This is the largest group of accounting professionals in the United States. It is the only board of accountancy in the United States that has a majority of public members on the board. We are a 15-member board. 8 of our members are from the public with no affiliation whatsoever to the accounting industry, and 7 members of the board are licensees. As the state's regulator of the accounting profession, the board's mission is to protect the public welfare, particularly consumers, by ensuring that qualified individuals are licensed to practice public accountancy, and that appropriate standards of competency and practice, including ethics, objectivity, and independence, are established and enforced. Our mission statement focuses on 2 main public protection functions performed by the board: licensing and enforcement. The licensing function establishes standards for entry into the profession, including examination, education, and experience requirements. And because of the dynamic, ever-changing nature of the profession, we have continuing education requirements to maintain and increase a licensee's current knowledge to continue to practice competently. Enforcement activities are focused on protecting consumers, minimizing substandard practice, rehabilitating licensees, and disciplining licensees where warranted. The board has recently been active in terms of implementing changes to the licensing requirements aimed at increasing the competency of our licensees. These changes can broadly be categorized under headings of continuing education and peer review. With respect to continuing education, over each 2-year licensure period, licensees must complete 80 hours of qualifying continuing education, with at least half of these hours in technical areas such as accounting, auditing, taxation, and ethics. At the time of renewal, the board reviews all licensees' continuing education to ensure compliance. As part of that 80-hour requirement, licensees that sign financial statements must complete at least 24 hours of continuing education in subjects such as financial statement preparation, accounting, auditing, and attestation or assurance services. In 2005, the board instituted a requirement that licensees examining financial statements must also complete 8 additional hours of continuing education specific to the detection and reporting of fraud in financial statements. Licensees found in noncompliance are notified and instructed to correct this deficiency. All licensees' failure to rectify any identified deficiency may lead to enforcement action. In this year, 2009, the board has also adopted regulations to establish new biannual ethics education requirements intended to emphasize ethics as the backbone of continuing professional development and provide the tools necessary to make objective, ethical decisions in public practice of CPAs. We require a minimum number of continuing education hours be completed annually in order to ensure licensees maintain a currency of knowledge throughout the 2-year period. And finally, with respect to continuing education, we require specific rules governing practice of public accountancy in California, emphasizing California's Accountancy Act and regulations, and providing licensees with a review of disciplinary actions by the board in the context of public practice. I mentioned peer review. During the current legislative session, the board is sponsoring Assembly Bill 138, which, if passed, would institute a peer review program requiring that all California licensed firms and practitioners performing accounting and auditing services undergo a systematic review of their accounting and auditing practices. The peer review program will assist the board in protecting the public by ensuring that only qualified persons and firms are licensed to practice public accountancy in California, and ensure that the work product provided to consumers is completed in accordance with professional standards. In my opinion, the passage of peer review as sponsored by the Board of Accountancy is the most important program to ensure quality financial reporting in California to be adopted in many years. There are two main benefits to having a peer review program in California, specifically related to the issues before this committee today. First, it will improve the quality of services provided by California licensed firms. Firms going through the rigor of peer review will be better equipped to perform quality accounting and auditing engagements in an ever-changing financial climate where there are constant updates to generally accepted accounting principles and auditing standards. It is imperative that the work product provided to consumers adhere to adopted professional standards. Secondly, peer review provides for increased consumer protection. Firms determined not to have met minimum professional standards will be issued a substandard peer review report and be required to submit that report to the Board of Accountancy for review by our Enforcement Division to determine if board action is required. Now, with respect to our enforcement program, which activities and investigations are at the heart of the board's secondary means of public protection and might be considered more characteristic of the watchdog focus than the board's licensing function. After ensuring that only individuals meeting specified competency levels are licensed, the board actively investigates complaints against licensees and disciplines licensees found to be in violation of the Accountancy Act or the board's regulations. Specific activities central to the enforcement program include receiving and responding to consumer complaints, monitoring news media, civil actions, actions by other regulators, and restated financial statements for leads. opening and conducting investigations of suspected California audit failures, and finally, pursuing discipline of CPAs and CPA firms, regardless of size, where evidence deems discipline to be appropriate. Unfortunately, I am unable to discuss open cases before this public committee, but the committee can be assured we have open, active cases that relate to your topic here today. However, it also must be realized that investigations of this complexity may take several years to complete. Several examples of completed cases that relate to financial issues include the Orange County bankruptcy, which was tied to derivatives, and recent cases involving abusive income tax shelters. Contested cases that require a full-scope investigation and litigation, such as the Orange County case, can take several years to complete. In fact, I believe that took 5 or 6 years. On the other side of the timeline, cases that involve sanctions by the Securities and Exchange Commission, the Public Company Accounting Oversight Board, the Internal Revenue Service, a California tax authority, or a conviction can proceed quickly and can be resolved in 4 to 6 months. An ongoing hindrance to the board's ability to make more advances in its public protection mandate of its enforcement program has been inadequate staffing. However, the board continually attempts to address the shortcomings. Some of these actions include increased enforcement program staffing by 3 positions in fiscal year 2007-8. That included 1 supervising investigative CPA and 2 analytical staff to assist non-technical investigations. We have completed a reorganization of the Enforcement Division with a focus on utilizing analytical positions to assist in non-technical investigations. We have engaged an outside contractor to study the Enforcement Division to fully assess where analytical staff can be used to assist in the investigations, thereby enabling investigative CPAs to focus their technical skills on the complex cases. Utilizing outside consultants to assist in investigations, we expect will be expanded, and that we will be hiring more of these consultants as needed. We have repeatedly attempted over the past 8 years to address recruitment and retention problems in the investigative CPA classification series caused by inadequate compensation levels. These efforts continue, and management is presently attempting to get the Department of Personnel Administration to revise pay differential number 347, the CPA retention bonus, to make it a more effective management recruitment and retention tool. We are also working to establish a career executive assignment position as chief of the Enforcement Division to ensure more successful recruitment for this critical position. It is critical because of the pending retirement of the incumbent chief later this month. The board is additionally addressing its oversight of accountants and the role accountants play in this state's financial matters through education of the public and public outreach. In matters of discipline, the board has recently adopted a transparency policy to post on its internet website the fact that the full text of accusations are available to the public as soon as they have been issued, and that final decisions made by our board are available on the web once a matter has been concluded by the board. When the board takes an enforcement action against an individual whose actions have harmed consumers or been particularly egregious, or whose story should serve as a warning to others, the board sends press releases to media outlets in the regions where the licensee was doing business. And periodically, the board distributes a newsletter to all licensees of the board, summarizing in detail its disciplinary actions since the prior newsletter. I would suggest a wise licensee should take these examples as a warning to improper practices. In conclusion, the catastrophic collapse of the mortgage lending market and financial markets has, as you know, resulted in worldwide financial damage to individuals, homeowners, businesses, corporations, banks, institutions, and governments. And while the economic downturn can be attributed to many issues and groups, the extent to which accounting standards and accounting professionals have contributed to the problem and are partially responsible will continue to be evaluated. But in closing, I would make two commitments to this committee and to the consumers of the state of California. First, that the California Board of Accountancy will continue to be active in its oversight of California CPAs and will investigate any allocation of licensees violating the laws governing the practice of public accountancy in our honorable state. And second, in its commitment to the consumers of California, this board will continue to evaluate the regulation of the practice of public accountancy in this state and will work with the legislature to ensure that licensees of the board are providing services to consumers worthy of trust. Thank you, sir.
Thank you. Before I ask Mr. Dufouchard to offer testimony, one of the last witnesses we had said that in his opinion there was more than adequate regulations on the books and that what was really necessary is more resources for enforcement. Do you agree with that? I mean, do you think there's enough?
Our problem with enforcement at this point, sir, has been the competitiveness of our salary level to engage people to staff the enforcement division. We have two supervisors within the chief and assistant chief within our enforcement division. We have 5 investigative CPAs. We would like to hire a number of additional individuals. The pay differential for a beginning member of our enforcement staff, who must be a CPA and must have 3 years of experience after receiving his CPA license, is at least $12,000 below the competitive salary in the marketplace. That makes it very hard to hire people. So we would appreciate any help you can give us there.
Yeah, obviously that, I mean, I can understand how competitive salaries are important.
Thank you.
But I'm sort of curious as to, given what was the development of essentially an unregulated market and some of the financial instruments sort of fell between the cracks. They weren't really part of banking and they weren't really part of mortgage lending. They became some other kind of animal. And in your discipline in accounting, I mean, do you believe that that accounting as a discipline has kept up with what's necessary in order to assess and evaluate these other kinds of financial instruments? Or does it just not make any difference?
Oh, no. I certainly think it makes a difference. On the other hand, I think as our first panel indicated today, part of this collapse was really created virtually overnight. There is an obligation of accountants to consider and evaluate the reserves for losses on derivatives, liabilities, and that type of thing. And the auditors do that generally with respect to financial statements on a 12-month basis. So some of this sort of caught us on the blind side. On the other hand, if there are failures in the proper evaluation and standards have not been met, we are prepared to take enforcement action in those cases.
I think you answered my question in terms of the staffing and the staffing level. I mean, my notes indicate you have 7 investigators for 76,000 licensees. Does that sound accurate?
There's about 81,000 licensees. There are 7 CPA licensed investigators. We also have additional staff that are not CPAs who handle some of the non-technical type activities, such as failure to be licensed, failure to have met the continuing education requirements, and some of those things.
But how many do you want? In a perfect world, wave your magic wand. Let's say you can assess a extraction fee against the oil companies in California and raise a little bit of money. What would you want to see?
Well, I would think with respect to the complexity of something against an oil company in California, we would probably use outside consultants. But let me ask our Chief of Enforcement. Mr. Newington, how many investigative CPAs would you like to have? And don't tell me 100.
Currently, we have 2 vacancies, plus we have a supervisor vacancy, and if those positions were filled, I think we would probably be in pretty good shape, but they've been vacant for a long time.
Okay.
And those numbers are going to grow in terms of vacancies in the very near future.
Yeah. Thank you. Thank you. Mr. Dufouchard.
Thank you, Chairman Nava. My name is Preston Dufouchard, and I am here today with Colleen Monahan, who is my Deputy Commissioner for the Office of Law and Policy of the Department of Corporations. First of all, let me just say that I want to commend this committee for taking an objective inquiry into the collapse of the mortgage lending industry. I think it's a very important exercise, and so I want to commend the committee for engaging in that, and I'm happy to be a part of that as well. I've been asked to talk about the department's response to the collapse in 2007 of certain mortgage lenders that we licensed, in particularly the New Century Financial collapse, and New Century was a large and prominent lender in the state. Consistent with the topic of this hearing, I want to begin briefly by discussing the role financial audits play in the department's programs. Under the California Residential Mortgage Lending Act, licensees such as New Century are required to provide the department with GAAP-compliant audited financial statements completed by an independent auditing firm no later than 105 days after the close of the company's fiscal year. If the auditor issues any qualification or adverse opinion, the reasons for such must be fully explained, and that's in Financial Code Section 50200. Our examiners review the audit statements prior to commencing their examination of the company, and among the things the examiners look for in the financials are qualifications or explanations by the auditors and funding sources to assure that the company's ability to make loans continues. So our examination actually commences at a much more granular level after we review the audited financials. We look at particular loan files to assess whether consumer disclosures have been provided and the appropriate fees have been disclosed with no overcharges to consumers. As this committee knows, New Century filed for bankruptcy in April 2007. Less than a year earlier, the department completed an examination of New Century in approximately October of 2006. As part of the normal examination process, as I've just described, the department reviewed New Century's latest audited financial statements, which would have been for the fiscal year ending 2005. And in that, it was a clean audit. There were no red flags, no qualifications or explanations by its auditor, KPMG. Accordingly, the department had no warning that the company's financial performance may have been something different than what its independent auditor stated. In 2006, New Century originated approximately $60 billion in loan originations. Of that, approximately $13 billion were originated in California. In January and February of 2007, we learned about mounting dislocations in the mortgage lending industry. Specifically, various lenders ceased operations due to their inability to obtain the funding needed to necessary to make loans. Warehouse lines were drying up as increased early payment defaults occurred, and increasingly companies were just unable to sell the loans that they were originating. In response to this, I initiated a program to identify the department's largest mortgage lenders by dollar volume and to contact them to get a real-time assessment of what problems the companies may have been experiencing. In particular, I was interested in assessing whether the companies had any impaired ability to fund the loans that they were agreeing to make to California consumers. At the same time, a group of other regulators, state regulators, for mortgage lenders began to coalesce. We compared notes to see, whether the companies were telling us the same things, and which problems the companies were identifying, and whether they had identified solutions to those problems. As the home state regulator for New Century, I was primarily responsible for leading conference calls along with other state regulators with New Century executives to discuss the nature of their financial problems and what were the measures New Century was taking to correct them. What we learned was that the company had lost access to their warehouse lines of credit, and part of this was due to the increasing number of defaults the company was experiencing in the loans that they were originating, and another had to do with the possibility of having to restate the company's earnings for several quarters in 2006. New Century's lenders provided funding, but the company would be in violation of the lending agreements if there was one quarter where the company failed to make a profit. And all of this is in the report to the bankruptcy trustee, as you know. But this is something we were learning sort of on the spot as we were dealing with the company. Accordingly, most, if not all, of New Century's warehouse lenders withdrew funding from the company. At this time, which was early March of 2007, New Century had about $6 billion worth of loan commitments it had underwritten across the country. And the regulators all asked that New Century stop taking new loan applications. At the same time, the company was seeking additional funding sources. In California, the company had about $2 billion worth of unfunded loan commitments. And of that amount, about $120 million had been approved. Financing documents were signed by the customers, and the customers were basically waiting for their loans to be funded. So we had a situation where real people were expecting their loans to be funded and to move into their homes or to get their refinancings as appropriate. I began to make calls to other banks and lenders. My efforts in this regard were designed to make sure that the California consumers who had negotiated a home purchase or refinancing were not left without the funding for the purchase or refinancing. I asked banks that I'd contacted to use their own underwriting criteria for the loans that were being reviewed, but to consider whatever portion of the portfolio that they could take. Through these efforts, we were able to move the New Century pipeline of loan commitments in its entirety to other lenders. The department filed an administrative order to discontinue operations against New Century on March 16, 2007. And a copy of that order is attached to my written testimony, and I'm submitting it here today. New Century filed for bankruptcy on April 2nd, 2007. As a contrast to what happened at New Century, I'd like to discuss another company that was experiencing accounting problems during this same period, but the ultimate result was very different. That company is Accredited Home Lenders, which is based in San Diego. They disclosed to the department that on March 30th, its auditor, Grant Thornton, had resigned. So Accredited, a lender who in 2006 originated $2.4 billion loans in California, could not file its report as required under our laws. After a brief delay, Accredited did retain a new audit firm, and the audit firm submitted its audited statements to the department. And while Grant Thornton did submit or I guess the company submitted the 8K, as was talked about earlier, and Grant Thornton signed off on it, we don't know the full reasons for their resignation, but we had some concerns that auditors were feeling somewhat gun-shy in this environment where mortgage lenders were starting to go under. We were informed that Grant Thornton resigned because in order to perform its audit, it would have had to increase the scope of its engagement. apparently Accredited had made an acquisition in 2006, and the accounting for goodwill associated with that acquisition was going to require Grant Thornton to broaden the scope of its audit, and it was unwilling to do so. So Accredited experienced the same margin calls that New Century had and faced shrinking warehouse lines. But since Accredited was not structured as a real estate investment trust, it had more retained earnings and was able to meet those margin calls by burning through cash reserves. Ultimately, Accredited, as I mentioned, filed its audit report, and the audit report contained no qualifications or other flags. So, totally different result. The market conditions I want to emphasize during this time were very tumultuous. Companies the department licensed were under severe stress as a result, and this presented a number of challenges to the department. Our program to obtain real-time information about the stresses was designed to assure that consumers would feel minimal impact under these conditions insofar as loan commitments were concerned. And we believe we met that objective. I also want to talk a little bit about some of the things that we did after this very tumultuous time period. There was a discussion about underwriting criteria and the relaxation of underwriting criteria in the mortgage lending market. We adopted by regulation at the end of 2007. I think our regulations became effective in the fall of 2007. Or at the end of 2007, very, very early in 2008, we adopted the guidance on non-traditional mortgage lending, which essentially calls for increased underwriting scrutiny for borrowers. And we also adopted a statement, the subprime, what's called the subprime statement on underwriting guidance, which prohibits lenders from making a loan unless the borrower can repay the loan at the fully indexed rate. So those are some of the steps that we took in sort of being prescriptive about what we could do to make sure this type of a bubble situation didn't recur, at least from an underwriting perspective as to our licensees. So that concludes my testimony. I'd be happy to answer any questions.
Thank you. If I could hear from Mr. Lacey, actually Dr. Lacey.
Or John. Okay.
Thank you.
Thank you. Well, I'm so happy to be here. The last time I was at the Capitol, I was a parent chaperone with my daughter's 4th grade class. And she's graduating from high school this week, and we had a nice time revisiting that experience. So it's nice to be here. I'm a first-generation college student. When I was a little boy, our house was foreclosed. My dad was a gardener. I remember that day. It was a dark day in our family. So this is a crisis that I understand from a personal perspective as well as a professional perspective. I'm a professor of accountancy, proud to be at California State University, Long Beach. I have a lot of first-generation college students there. Some of their families have faced this crisis too. Prior to teaching at Cal State Long Beach, I taught at USC, UCLA. I'm a CPA licensed in California, proud to be. And I practiced in public accounting at one of the big CPA firms. I was also controller of a manufacturing company for a while, so I prepared financial statements as an inside accountant. My brother and I own a small business together, have for 30 years. So I've participated in this process for a long time. As well as teaching at the university, I also teach bankers and investors. So I regularly, maybe 200, 300 hours a year, spend time talking to people who make investment and credit decisions using the information that accountants provide, helping them to understand those financial statements. I also teach accounting to judges. I've written accounting standards and voted on accounting standards. There are about 30 people in the United States who vote on those standards, and I'm proud to be involved in that process. So I have some insight about how the standards are written as well. I've done a research project for the SEC on auditor independence, spent 3 years of my life on that at one point. And I've served as an expert witness in some of the big legal cases in our country and have learned from that process. I've been active in our profession for over 30 years, and I recently chaired a committee of the California Society of CPAs looking at the future of our profession in California. Our committee made some recommendations about things that we thought would help. That was following the problems in Enron and WorldCom. So I'd like to begin by talking about the role of the independent auditor in this process. The independent auditor is one of many participants in the process. There are mortgage bankers, investment bankers, buyers of homes, company managers, lots of people involved in this process, and the auditors are one of those parties involved. The financial statements that companies prepare and on which auditors opine are one of the inputs to the process that lenders and investors use in making investment and credit decisions. But it's only one of many inputs to that process. I taught financial statement analysis at UCLA, and I talk to investors and bankers regularly, and accounting is an input, but it's one of the inputs. So it isn't the only information available to them by any stretch. So the independent auditor is hired by the audit committee of a company. The audit committee is comprised of outside directors who are not part of management. So the audit committee hires the independent auditors and then interfaces with those independent auditors during the conduct of the audit. The auditor is engaged to conduct an audit in accordance with generally accepted auditing standards. Those auditing standards now are the responsibility of the Public Company Accounting Oversight Board, which is a quasi-governmental organization. The members are appointed by the SEC. The audit is, the purpose of the audit is to provide an opinion on the financial statements prepared by the company. The opinion is going to state whether the financial statements present fairly to the readers of the information. Now, the financial statements are to be in accordance with generally accepted accounting principles. I mentioned to you that I voted on some of those principles and wrote one of them. The body that's primarily responsible for that in the United States is the Financial Accounting Standards Board. So they write standards currently, but it's a large body of standards, a lot of technical standards, and there are a lot of hard calls in interpreting those standards. When I worked in public accounting, one of my jobs was to interpret those standards and apply them in particular circumstances where everyone wouldn't necessarily agree. So there's judgment and estimates that are required in applying those standards. That's one of the things that I talk to my judges about when I'm teaching accounting to judges. Another important thing about financial statements is they have a date. So if we're auditing a set of financial statements, they have a date, maybe December 31st, 2008. So as we look at those financial statements, the values on the financial statement relate to that date. The revenues and expenses relate to the period that precedes that date. Now, we apply generally accepted accounting principles to the financial statements. That's how they're prepared by the company. And then we make an evaluation of whether they present fairly. So as we look at the financial statements at a date, and there's a value on that date, the question is the value correct on that date? And it may change later. So, for example, we may have a mortgage loan, that's a $270,000 mortgage loan, on a $300,000 house. And the mortgage loan is considered to be collectible, and then time passes, and later in the year, the house is worth $200,000. You now have a mortgage loan that is greater than the value of the house, substantially greater. So the value is going to change on that mortgage loan. Was the value wrong at December 31st? No. It was correct at December 31st, but later the answer is different. It's often easy to look later and say, oh, we should have known that something was going to happen, but the transaction occurred at that date, there was a value at that date, and it was probably true at that date. Things change. So we report at a date on financial statements. Now, the report is historical. We report on what has happened, what report on management's decisions on past transactions. And so the financial statements reflect those results. They don't predict what's going to happen in the future. I often tell my students I would love to be able to give each one of them a crystal ball as they cross the podium or across the stage as they're graduating. We're short on crystal balls, I'm afraid, or at least ones that have any reliability. So the responsibility of management is to prepare the financial statements. The responsibility of the auditors is to conduct an audit and provide an opinion on those financial statements. And it is the company that prepares the financial statements. When I was controller of a manufacturing company, my job was to prepare the financial statements and the disclosures that went with those financial statements. The financial statements then are prepared in accordance with GAAP. The auditor conducts an audit. If the auditor concludes that the financial statements are in accordance with GAAP, in accordance with these standards that have been set, then they provide an opinion that says the financial statements present fairly. But remember that it says they present fairly in conformity with generally accepted accounting principles. So if I'm the auditor, I can't write my own principles. I have to follow the principles that exist. I have to follow auditing standards that have been written. So I have a role, and I am to follow that role. The disclosure requirements in the financial statements must meet those minimum standards, the standards within GAAP. If they don't, then there's a problem. The estimates and judgments must be reasonable that are made. But again, there are estimates and judgments inherent in this process. Not everyone is going to agree on exact amounts. So that's the role of the auditor in this process. Now, we also have standard setters, and I mentioned to you two. One, the Financial Accounting Standards Board. That body writes accounting standards in the United States. The other is the Public Company Accounting Oversight Board. So the FASB, the Financial Accounting Standards Board, is an independent standard setter, but it's subject to the oversight by the SEC. It is currently working with the International Accounting Standards Board collaboratively on most of its projects. If you look at the website of the FASB, which I'm sure you as I have it as your homepage, because what could be more interesting? Anyway, I actually do. That's a sad reality, isn't it? If you look at that web page, you'll find that the projects are being done collaboratively, most of them, with the International Accounting Standards Board. And you'll find on both websites a focus on the financial crisis that we've been facing. And the accounting standard setting bodies are trying to improve our financial reporting standards to address those problems. If you look at, for example, some items that are on the agenda currently, there's a recent standard that's been issued on fair value. How should accountants assess fair value? What inputs should we look at most importantly? And some interpretations of that. The International Accounting Standards Board has just issued an exposure draft that follows what we've done very, very closely. Also, there are projects related to consolidation of financial statements. When you have more than one company and there's joint ownership between these companies, how should we add those financial statements together? When should we add those financial statements together? When there's a transfer of financial assets, which we've seen in this industry, when should that transfer be shown to have occurred? So those are all things that the standard setters are working on, and working on very aggressively at this point in time. I'm on a committee of the California Society of CPAs and chaired that committee that comments on these standards on behalf of our CPAs in California, and we've been very busy writing comment letters about these standards, trying to help in the process to make them better. The PCAOB, the Public Company Accounting Oversight Board, has a strategic plan to improve the auditing process in public companies. And in general, our profession has undertaken several projects, studies to try to improve the process. I'm proud of the report that my committee wrote. We spent a lot of time. The California Society said, we're not going to put any constraints on you. Just do what you think is right, and we'll publish it. And I had people outside of the accounting profession. I was very pleased that they gave us that latitude, and I think we had some good recommendations. So in summary, the auditors and the accounting profession is one of many participants in this process. There are lots of people involved in this. We prepare financial statements as accountants, and as auditors, we audit those financial statements. That's our role in this process. The financial statements have a date, and the financial statements then reflect what has happened in the past, not what's going to happen in the future. Some of the assets are reported at different values, and as I mentioned, the accounting profession is working on improving our standards about defining those values. If you think about our process as accountants and the accounting profession, we don't make managerial decisions. We don't decide on interest rates. We don't decide on which parties to lend to. We're more like reporters at a newspaper. We don't start fires, we report on fires. It's not our job to put out fires. Our job is to report, and to report fairly. Well, thank you for your time.
So, as I think about the testimony that you've all offered here today, what I'm going to be interested in as we continue these conversations is, other than appropriating resources for more investigators and in making adjustments for compensation so that you can be competitive, because I do think that is a problem. And there is a mood out there with the public that for some reason public employees have been devalued, and I think it's very short-sighted, given the complexity of the responsibilities that you have in accounting, to fail to appreciate that in fact it is a demanding profession with significant levels of complexity, depending upon what particular businesses and hybrids of businesses that you're involved in. But I'm still trying to assess, and I'm sure that we'll do additional hearings on other areas of this, other aspects of this. But I'm still trying to assess, how is it that, and maybe the legislature doesn't have a role in this. Maybe this is going to have to come out of some aspect of the regulatory bodies or your own peer bodies. How is it that we enhance consumer protection, given that the accountants have this obligation to the public? And speaking to you that are involved in audits and in accounting, I mean, have you ever found yourself in a situation where you were auditing a publicly traded company, and let's just say that the evaluation of assets by the directors was a little enthusiastic as compared to what its real value was once you looked at it? And so what are the options that are available to you as an accountant to inform, and who would you inform when you see that kind of a situation? What prohibits you from inform, and who would you disclose this information to?
Well, I think the first disclosure would be to the management themselves. Why is there a difference of opinion with respect to the enthusiastic valuation of assets? Secondly, I think, as Professor Lacey said, there are audit committees. The audit committees are supposed to be independent of management. Thirdly, if it's a public company, and as previously explained, if the audit committee doesn't take appropriate action, then there's obligations for filing reports with the SEC, or, if necessary, resigning. So there are safeguards there. I think when you And this doesn't excuse it, but when you get down to 81,000 licensees in the state of California, we have very, very few bad apples. Now, that doesn't mean we are tolerant of that. We don't want any bad apples. But I look at the individuals who have been disciplined within the last 2 years. I asked for a report in connection with this hearing, and we've got maybe 65 individuals out of the 81,000 who have had their licenses suspended or revoked or put on probation or other, you might say, serious discipline initiated. If there are more, we need to identify the additional ones, but we work very hard at identifying those. And we have to impress upon the licensees that there are consequences of failures to meet standards.
Within the academic world, I can tell you there's been an increased focus on ethics in our classes. If you look at the textbook that I use today in my classroom, every chapter has 1 or 2 cases involving ethics and accounting. And in my classroom, we talk about those cases. And I think really, if you look at how can we solve this problem in the long run, I think it's an awareness issue. We need to make our students aware of this. We need to make our young professionals aware of this issue. And I can tell you that it's better as I see it today. And I think also our students are more aware of these issues because of what's in the news. But bad things happen. They always have. They always will. The economy has troubles one way or another, and something goes wrong. And then we look around to see who caused it. And I think that's just inevitable.
Well, to supplement Dr. Lacey's comments with respect to awareness, we at the Board of Accountancy have, in the last several months, actively discussed public expectations of the use of financial statements. I was at a Audit Quality Center presentation in San Francisco. Audit Quality Center is a national group addressing audit quality, as in their title. And they had a venture capital individual there, and he remarked that with respect to startup businesses, he didn't even use the financial statements. When they were given to him in the reporting package, he literally ripped them out. He was much more interested in cash flow and the disclosures. And so it isn't necessarily what the balance sheet shows on December 31. It's what's in those disclosures as to how valuations were reached. And people can't just look at the financial statements and say there's a clean opinion. If they're going to use those financial statements for investment decisions, they have to look at the sustainability of the company and the disclosures and other factors. And I think we on the board have a responsibility to help educate the public, to guide expectations, and we are addressing that. But, as you know, there's many million of people in California.
Do you have any concluding remarks before I invite the next panel up?
Well, I've been very satisfied with the presentations today. I think they've been very helpful. I personally was not prepared to discuss the causes of the financial collapse, but I think Professor Atkinson and Mr. Bonzi did an excellent job of that, and I was very appreciative to hear their comments.
Well, good. That's what we try to do here. All right. Thank you very much.
Thank you. Thank you.
Next panel is titled, How Can the Accounting Profession Protect the Public and Help Prevent the Reoccurrence? We have Lisa Troe and Ed Howard. Welcome.
Thank you.
Lisa Tro. Thank you for having me here today. I appreciate the opportunity to try to be helpful. I wish to emphasize that these views are my own and not those of my firm. When I was at the Securities and Exchange Commission doing regulator work, I got into the habit of saying that with respect to the commission. I am a CPA. Before I became a CPA, I did corporate accounting and industry. I then worked for a predecessor firm of Deloitte & Touche. I returned to private enterprise and then joined the SEC staff. I've been a regulator engaged in oversight for longer than I've been an auditor and a consultant, but I have been on all sides of the table. At the SEC, I reviewed all accounting, financial reporting, financial disclosure related financial fraud and audit failure cases, investigations. We investigated, and I was responsible for had senior supervisory responsibility for investigating companies, corporate officers, third parties, including attorneys and accountants. We took sworn testimony of auditors. We reviewed audit work papers. Whenever there was an investigation concerning a possible financial fraud, we always looked at the auditor conduct as well. We would recommend at the conclusion of an investigation whether and what enforcement action to take. I participated in that. I would recommend that. And I would also supervise the enforcement accountant's participation in administrative proceedings when the accountant was supporting the administrative proceeding process when the SEC would adjudicate against or actually sanction or attempt to sanction an auditor. I participated in a multitude of SEC investigations, including the Orange County bankruptcy that was mentioned earlier, Gemstar, TV Guide International, Home Store, Global Crossing. I left the SEC in 2005 to become a senior managing director at FTI Consulting. FTI is an event-driven global business advisory firm. We have offices in most major financial centers around the globe. We have 5 business practices. I am in the forensic and litigation consulting practice, specifically investigations and forensic accounting. I would like to really do 3 things: weigh in on the broad question that seems to be of interest to the committee, address a few specific issues that have come up, and then spend most of my time talking about the federal regulatory system concerning accountants and specifically auditors engaged in auditing financial statements. I believe that the federal regulatory framework in place concerning accountants, if applied, is adequate. There seems to be a question about the extent to which, if at all, accounting or inadequate accounting oversight contributed to the financial crisis. My view is that bad accounting or inadequate accounting oversight did not contribute in a meaningful way. The problem was not how the subprime mortgage securitization or derivative transactions were accounted for. The problem was the transactions themselves. I've heard it described as there are 1,000 barbarians at the gate. You count there are 932. The problem is not that you counted 932. The problem is there are 1,000 barbarians at the gate. Mr. Basney in Panel 1 described the U.S. Congress mandating the SEC staff to do a report looking at fair value accounting, mark-to-market, although the staff broadened that to fair value accounting, and to see whether what the linkages were between fair value accounting and the usefulness of information provided by the financial institutions. And I agree that that is an important report to look to. And there are a couple of key observations that I would make about that are made in the report. Specifically, These market participants, particularly investors, pointed to what they believe are the root causes of the crisis, namely poor lending decisions and inadequate risk management, combined with shortcomings in the current approach to supervision and regulation rather than accounting. And then one other key observation from the report, and that is, quote, the staff believes that it's important to recognize what many believe to be the larger problem in the financial crisis that led to the financial distress in financial institutions other than banks, including Bear Stearns, Lehman Brothers, Merrill Lynch. Rather than a crisis precipitated by fair value accounting, the crisis was, quote, a run on the bank, unquote, at certain institutions, manifesting itself in counterparties reducing or eliminating the various credit and other risk exposures they had to each firm. This was in part the result of massive deleveraging of balance sheets by market participants and reduced appetite for risk as margin calls increased, putting enormous pressure on asset prices and creating, and then the SEC staff quotes Timothy Geithner, a, quote, again, this is Geithner, self-reinforcing downward spiral of higher haircuts, forced sales, lower prices, higher volatility, and still lower prices, unquote. And then in the staff's report, the staff goes on to say, the trust and confidence that counterparties require in one another in order to lend, trade, or engage in similar risk-based transactions evaporated to various degrees for each firm very quickly. And we've been hearing this afternoon that it was very sudden. Mr. Basney also made reference to the report indicating that the bank failures in the U.S. appeared to be the result of growing probable credit losses, concerns about asset quality, and in certain cases eroding lender and investor confidence, which really is key to findings. The report also, the staff found after its study that there were improvements that could be made in the accounting, in the fair value accounting, but that it ought not be discarded, that it was overall the preferred method. So when the staff reports, quote, fair value accounting did not appear to play a meaningful role in the bank failures that occurred in 2008, unquote, and that's from the SEC's press release. What that really means is that accounting did not play a meaningful role. As we've heard this afternoon, of course, and as you already know, the regulatory scheme has many parts and is extensive. I believe that to the extent there are holes in the system, the federal government is going to plug those holes. The current federal system as it relates to accountants includes, as you've heard, the SEC and the Public Company Accounting Oversight Board, at least with respect to auditors of financial statements of public companies. The SEC provides not only the oversight for auditors, accountants, but also has statutory authority to determine the accounting itself. And the Public Company Accounting Oversight Board, which is a real mouthful, so I'm going to refer to it as the board, provides oversight of accountants, specifically auditors, and determines accounting standards for audits of public companies. The Sarbanes-Oxley Act of 2002 increased requirements of auditors and of management in dealing with auditors. And I think those are important enhancements in the regulatory scheme, if you will. I'd like to, before I talk about the SEC and the board and some of the new SOX requirements, Sarbanes-Oxley Act, also a mouthful, so SOX, I'd like to clarify an issue that came up at the last informational hearing, because I was confused, and I think there was confusion in that as I was reading the transcript from the hearing. At the last hearing on May 4th, Mr. Dunn stated that, quote, in approximately 2000, this legislator passed a bill creating an accountant-client privilege, unquote. It seems that this gave the misimpression that an accountant-client privilege exists in the state of California relating to audit work. And my understanding is that no such privilege exists in the state of California. There is at the federal level a limited accountant-client privilege relating to tax returns, documents and work product relating to tax returns. But with respect to audits and auditors, no such accountant-client privilege exists in the state of California, as far as I understand. You asked a little while ago, Chairman, how do we enhance consumer protection? And one of the answers, and you heard it a couple times this afternoon, the process that an auditor is required to go through if the auditor finds that there may be a problem, possible illegal act by a client. And in addition to all of that which has already been described in that process, the Private Securities Litigation Reform Act amended the 34 Act, the Securities Exchange Act of 1934, to include a Section 10 Cap A. And Section 10 Cap A is the section on audit requirements and includes, in addition to what you already heard an auditor needs to go through, that if the auditor, after reporting to the audit committee or the board, and the auditor is not satisfied, then not only is there the option to resign and the need to file a Form 8K, that is, the issuer filing the Form 8K with the commission, but also that the auditor must file what's referred to as a 10 Cap A report with the SEC staff, specifically the Office of the Chief Accountant, describing the facts and circumstances. And that report, I believe, is not public. They are, based on my experience at the SEC, were filed from time to time, and the SEC staff takes them very seriously. So there's also that reporting process in place, which is even separate and apart from the Form 8K process. There are many Forms 8K filed, although those that relate to changes in accountants are flagged, but the 10 Cap A reports are even more special.
Well, let me ask you, because you were referring to the transcript with Senator Dunn, and there's no accountant-client privilege. There was also testimony, and I'm assuming you read more than Senator Dunn's testimony, but there was also some reference to the fact that who has standing to bring an action if an investor believes that there's been negligence on the part of the accountant with respect to executing their duties. And the way that it was explained to me at that time, at that hearing, was that an investor has no standing to bring an action against an accountant under a theory of negligence for failing to perform their duties appropriately when they're conducting an audit. Is that your understanding as well?
I am not a lawyer, and what I really know about is the standards by which the Securities and Exchange Commission and the Public Company Accounting Oversight Board have with respect to sanctioning auditors. And there is a negligence standard for the SEC. The SEC does sanction auditors for negligence, and that is specifically defined by the SEC's rules of practice.
And what are the consequences to an auditor if the sanctions are imposed by the SEC?
Well, the sanctions can be anything from a censure to a prohibition to appear or practice before the commission for some period of time, after which the accountant may reapply to appear before the SEC. So there's no guarantee that after that time period is up, the accountant will be permitted to sign off on audit reports of public companies again.
Right.
The accountant can be permanently prohibited from auditing public companies.
So the sanction is specific to the particular auditor.
Correct.
And so I think what I'm what I'm trying to comb through and figure out is at what point does an aggrieved investor have access to courts if the loss if they believe that the loss is also attributable to some negligence on the part of the accountant. And I don't know that there's a clear path for that. Certainly what we learned at that first hearing was that the only reason why the investors in New Century were able to make the progress that they did was because they became trustees under the bankruptcy. Because my understanding is that as mere investors, they have no standing to bring an action. And so while I appreciate that the SEC has the enforcement powers to fashion sanctions for an accountant or the firm, I assume, that are specific to that entity, I'm not so sure that inures to the benefit of the public in the way that I'm sort of trying to better understand it. But I appreciate you explaining that to me, because that gives me an additional appreciation for responsibilities of accountants and sanctions that are possible under the SEC.
But with respect to protecting investors and protecting the SEC's process, the sanctions that the SEC can impose and does impose are intended to, and I believe do, contribute to protecting investors. And the sanctions, the ability to sanction is there to protect investors and protect the Commission's processes. The Commission's processes including transparency, and I mean the Commission cannot look at every single financial statement. So, I mean, the SEC's mission is three-part, one of which, and really the crux of which, is protecting investors. So, I mean, also capital formation. But so I think that more broadly, to the extent the bad apples, as was described earlier, are identified and taken out of the practice of accounting that is specifically auditing public companies, investors can be protected from that, from those bad apples.
Right. Right. Good. Thank you.
Of course, well, going back to the SEC and suing auditors for improper professional conduct. Of course, the SEC can file a civil action for fraud. The SEC can also bring an action administratively, which can be appealed to the Commission, which can ultimately be appealed to the U.S. Circuit Court of Appeals. In an SEC administrative proceeding, the Commission can order the accountant to cease and desist from violating provisions of the federal securities laws, such as causing a issuer's reporting violation, or of course anti-fraud provisions. Can sanction the accountant, as we just talked about, under a negligence standard or a recklessness standard. So can sanction the accountant under the Commission's rules of practice, including under a negligence standard. And this applies to, I mentioned applies to accountants who appear or practice before the Commission, and what that means is prepare, review, or approve financial statements that are included in an SEC filing, which is then available to the public. And also, practicing and appearing also includes auditing financial statements of public companies. The standard under the rules of practice is to look to whether the accountant is one who does not possess the requisite qualifications to represent others, or be lacking in character or integrity, or have engaged in unethical or improper professional conduct. and then to willfully violated or willfully aided and abetted the violation of any provision of the federal securities laws. So there are three types of improper professional conduct, and this is where the negligence standard comes. There is, first, intentional or knowing conduct, including reckless conduct, that results in a violation of professional standards. And then either of the following two types of negligent conduct. A single instance of highly unreasonable conduct that results in a violation of professional standards in circumstances where the accountant knew or should have known that heightened scrutiny is warranted. And then the second prong of the negligence standard is repeated instances of unreasonable conduct, each resulting in a violation of professional standards that indicate a lack of competence to practice before the commission. So repeated instances of unreasonable conduct, the SEC staff in my experience, interpret it as more than one. So the SEC, in its final rule release on this Rule 102 of the Rules of Practice, described the term unreasonable and what does unreasonable mean, and distinguished it from highly unreasonable, and said that, quote, the term unreasonable is distinguished from the term highly unreasonable, connotes an ordinary or simple negligence standard. So the lower standard of culpability is justified in this instance because the repetition of the unreasonable conduct may show the accountant's lack of competence to practice before the commission, and if an accountant fails to exercise reasonable care on more than one occasion, the commission's processes may be threatened, unquote. The commission also described in that final release that Rule 102E was not meant to cover every misstep, every professional misstep, is the way they put it. And I can also tell you that when an accountant is sanctioned by the SEC, as a general matter, that accountant's career is over. The SEC also cooperates with the Department of Justice, with Department of Justice investigations into possible criminal conduct, including of auditors. And there have been a few criminal prosecutions. One was a situation in which a couple of auditors were incarcerated as a result of conduct. There was also mention at the last hearing of 2 criminal actions against 2 firms, and I assume that one of those was a reference to Arthur Andersen in connection with Enron. And we ought not forget that with respect to Arthur Andersen, there were 85,000 people who lost their jobs, and the criminal conviction was later reversed. So we need to be very careful. There was discussion at the last hearing about possible concern relating to what I would call anecdotal evidence that auditors are in bed with their clients, that the auditor at times gets too friendly with the client, that the suggestion historically has been that the auditor's mental state of independence may be questioned, may be impaired. In these days, the Enron example is cited, of course, with the example of Andersen auditors becoming Enron employees and the like. The Sarbanes-Oxley Act put into place several prohibitions to address these potential auditor independence and conflicts of interest questions. For example, under Sarbanes-Oxley Section 206, entitled Conflicts of Interest, the statute states that it shall be, quote, it shall be unlawful for a registered public accounting firm to perform for an issuer any audit services required if a CEO, controller, chief financial officer, chief accounting officer, or any person serving in an equivalent position for the issuer was employed by that registered public accounting firm within or during the 1-year period preceding the date of the initiation of the audit. So it's more than a year. Another example is Section 303 of SOX entitled Improper Influence on Conduct of Audits, which makes it illegal for any action. So it makes illegal, quote, any action, and I respect that you're an attorney, so I want to be precise about these words because these are important.
Don't burden me with that. It's okay.
It makes illegal, quote, any action to fraudulently induce, coerce, manipulate, or mislead any independent, public, or certified accountant engaged in the performance of an audit. Of course, of a public company. There are several more independence-related and conflicts of interest-related enhancements that SOX brought into being. One relates to non-audit services. Pre-approval is required for non-audit services, and as you heard earlier, it is the audit committee that hires the auditor. So the audit committee must pre-approve those non-audit services. Those non-audit services also get disclosed to the public in an SEC filing. There is a requirement under SOX now that the audit partner be rotated. So at least every 5 years, the audit partner needs to change, to have a change of the guard. The auditors are now required to report to the audit committee three important things. One is all critical accounting policies and practices to be used. And then particularly important, all alternate treatments of financial information within GAAP that have been discussed with management. So it may be an acceptable method. Nevertheless, it needs to be discussed with the audit committee. And also to discuss not only the treatment, but also the consequences thereof. And then other material written communications with management need to be provided to the audit committee. So SOX is enhanced to try to address some of these independence and conflicts of interest issues. Let me talk just briefly about the Public Company Accounting Oversight Board. You heard that they have an inspection process. They were, of course, as you know, derived from Sarbanes-Oxley. They are a nonprofit organization. The purpose is to promote higher professional standards and to improve the practice of accounting and the profession over the long term. In general, auditors of public companies are in the jurisdiction of the Public Company Accounting Oversight Board, and the board has an inspections program, enforcement, and investigations, and then also rulemaking. The investigations process, and actually let me talk about inspection for just a minute. If an auditor or audit firm audits at least 100 or actually over 100 public companies, the board inspects that audit firm every year, and if it's under 100, then it's every 3 years. So it's quite often, and the process is for the reviewers, the inspectors, to review audit work on numerous audits. The board inspectors decide which audits they're going to look at, not the audit firm, and the inspectors evaluate the quality control policies and procedures that the firm has in place, as well as looking at the substantive audit work. So the investigations and enforcement program works somewhat similarly to the SEC. And in fact, the rules of practice, the process is similar to the SEC. The board can also impose civil monetary penalties as well as censuring or going up to prohibiting an auditor from auditing public companies. So I think I'm going to, I would like to say one other thing. There are, you had asked earlier, how do we enhance consumer protection? And what keeps coming to mind this afternoon with respect to that question is something that actually a board member has talked about, and that is integrity, and that's at all levels, not just auditors, but all levels. So I think I'll stop there. It's late in the afternoon.
Thank you very much. Mr. Howard?
Good afternoon, Mr. Chairman. I'm Ed Howard, Senior Counsel with the Center for Public Interest Law. Again, thank you for allowing us the opportunity to testify. I'd like to touch on 5 things, hopefully briefly. The first is very quickly to revisit the role of the accounting profession, and its audit function and its importance to your constituents and, in fact, all Californians. The second is to discuss briefly the evidence so far indicating that there may be a problem with the accounting profession having contributed to the current economic crisis, and specifically where it relates to financial institutions such as Countrywide, New Century, and Investment Bank. The third is I would like to touch briefly on the record of some of the regulators mentioned today, specifically the PCAOB and the California Board of Accountancy. The fourth, I'd like to touch briefly on some of the reforms that were mentioned by my panel colleague, specifically arising out of Sarbanes-Oxley, and whether or not they're adequate to protect consumers. And then fifth and finally, I'd like to revisit and maybe provide some suggestions as to how to think about legislative reforms and other reforms that might help ameliorate some of these problems. I think beginning first, a quick contextualizing rewind about the importance of this profession. We heard some testimony today that made it sound as though that basically all CPAs who audit do is offer opinions and nothing more. And it is true, of course, that a CPA, for example, who is working on a 10K does not make management decisions and those sorts of things. But as the Supreme Court reminds us, and as I think another panelist reminded us, the CPA profession performs a watchdog function over almost all of the important commercial decisions that we have engaged in, including the financial, including financial instruments and institutions that touch all of our lives. And that watchdog role, as the U.S. Supreme Court reminds us, is one that watchdogs on behalf of the public, not the client who may be paying the watchdog. That parenthetically reveals the core regulatory challenge here. That is, that you have a private actor who has a very public responsibility who is being paid privately. There is nothing unlawful or even nefarious about that, or even unethical about it. But in other circumstances where we see other kinds of potential conflicts between the interests of the public and between the people who are paying the people who are supposed to protect the public, we do see very vigorous and very comprehensive regulatory regimes. Insurance, for example. Healthcare, for example. HMOs, for example. So the importance of this profession and that watchdog role, even though it is a watchdog role and not a management role, is really hard to overstate. Relatedly, when we're talking about this watchdog role, as a practical matter, what we are for significant companies like the financial institutions that this hearing is about, we're really talking about a very few, very large companies, namely the Big Four, who, according to material provided in your last background paper, do more than 90% of the audits of public companies in the United States. Those 4 companies' gross revenue combined approaches the budget of the entire state of California. about $100 billion. So when we're talking about the regulatory issues, whether federal or state, we're talking about not merely the ability and muscle of regulators to be able to deal with an individual like the guy who does my taxes who lives in North Natomas. We're talking about whether or not the regulators have the laws and the resources to be able to combat some of the biggest companies in the world. That concludes, I think, the first point about what the role of the accounting profession is and really the companies, I think, that we're in the main talking about. The second is the question of whether the accounting firms had a role in the current financial crisis. And we heard some rather definitive statements earlier that that was not the case. I think that there is evidence. The autopsy on what caused the economic crisis has yet to be finished. And so the only thing, and we will probably not be finished for quite some time, the only thing that legislators like yourself, Mr. Chairman, can do, and that regulators can do, and that policymakers can do, is look at the evidence as it bubbles up and make a determination about whether or not those data warrant asking hard questions. And measured that way, I think the answer is amply justified that there is a sufficient amount of evidence to ask some very hard questions, as the chair has been asking. I think perhaps the most trenchant examples of those come from not a complaint filed by a plaintiff's firm, but from the final report of the bankruptcy court examiner in the New Century case that was made a part of your materials for this hearing. Just some excerpts from that, Mr. Chairman. Quote, several interviewees claim that KPMG actually recommended the improper changes to the purchase reserve calculation that were made in the second and third quarters of 2006. New Century is ultimately responsible for the accuracy of its financial statements. But KPMG bears responsibility at minimum for suggesting accounting changes in the second and third quarters of 2006 that were inconsistent with GAAP, and for failing to detect the material understatements of the repurchase reserve and the LOCOM valuation account. And there's more. As a consequence of these accounting failures, New Century understated its repurchase reserve by as much as 1,000% in the third quarter of 2006 and reported a profit of $63.5 million in the third quarter when it should have reported a loss. And there's more. KPMG contributed to these failings in critical ways. Among other inadequacies, KPMG failed to question or test certain important assumptions in a rigorous manner. The KPMG engagement team acquiesced in New Century's departures from prescribed accounting methodologies and often resisted or ignored valid recommendations from specialists within KPMG. Continuing, when one KPMG specialist persisted in objecting to a particular accounting practice on the eve of the company's 2005 Form 10-K filing, an objection that was well-founded and later led to a change in the company's practice, the lead KPMG engagement partner told him in an email, quote, I'm very disappointed we are still discussing this. As far as I'm concerned, we are done. The client thinks we are done. All we are going to do is piss everybody off, end quote. But there's more. In an article published in December 2008, professors of accounting William Vandenberg and Philip Harmelink concluded the following. The blatant disregard of basic accounting and auditing concepts was evident in the subprime sector. The failure of lenders and their auditors to perform a simple verification of borrowers' income and credit histories is a contributing cause to the ongoing crisis. Poor loan underwriting practices should have easily been identified, even in the most basic audits, and then should have been adequately addressed. And there's more. The liquidators of two Bear Stearns companies, again, these are liquidators, have sued not only Bear Stearns, but its auditors, Deloitte & Touche. The San Mateo County Investment Pool has named the accounting company Ernst & Young as a defendant in an ongoing case. Quoting from the New York Times, December 2008, quote, as more details unfurl in the Bernard Madoff fraud case, so do the lawsuits. And the big accounting firms, which oversaw many of the feeder funds, these are the funds that gave Mr. Madoff money to invest, many of the feeder funds that funneled billions of dollars into what prosecutors describe as the largest Ponzi scheme ever perpetrated are likely to be among the defendants. October 2008, PricewaterhouseCoopers, the independent auditor for American International Group, AIG, will pay $97.5 million to settle a class action securities fraud lawsuit against the insurance giant and others. Now, one of the other panelists correctly said that one should not definitively infer criminal or even civil wrongdoing from any of these sources, and that's entirely true. But neither should these things be dismissed. As some, in their place, substitute an assertion that everything is fine and that we need not look any further at this issue. That is not only the case because the number of lawsuits, in addition to the liquidator's report, should make anybody pause and at least take a hard look, but it comes in the last 10 years where we have seen two of the biggest firms, Arthur Andersen, who was convicted and whose conviction was overturned because of a flaw in the jury instruction in the U.S. Supreme Court, criminally convicted for criminal wrongdoing, but also more recently, KPMG admitting as a firm to criminal wrongdoing in the single largest tax fraud case in American history, coming again on the heels of Enron, WorldCom, Tyco, HealthSouth, and what have you. So it may be that if we had not had Enron, WorldCom, Tyco, and HealthSouth, and Arthur Andersen, and a guilty plea on behalf of an entire, or an admission of guilt on behalf of an entire firm in a tax fraud case, that maybe we should be more dismissive of the independent bankruptcy court examiner's conclusions and the multiplicity of civil lawsuits that are currently being filed. But I don't think you should ignore them in and of themselves, let alone against that troubling backdrop. I'd like to move on to my third point, which is the record of the regulators. And I do want to focus in on one thing because it's important, in my opinion, not just in and of itself, but as sort of a metaphor for how these problems could stubbornly persist over time. My panel colleague mentioned the PCAOB and its new jurisdiction under Sarbanes-Oxley. But as Compliance Week reported in December of 2007, quote, audit regulators have taken their first significant disciplinary swipe, finally, at a Big Four accounting firm, fining Deloitte & Touche $1 million for a 2003 audit failure and barring a single Deloitte audit partner from auditing public companies. The fine marks the first time the PCAOB has punished a major audit firm, something critics of the auditing firms believe is long overdue. The PCAOB has a total of 30 attorneys and accountants tasked with enforcement. And the board's 2008 budget calls for a few additional staffers next year, according to PCAOB Chair Olson. On whether that staffing can take on the defense bar at the disposal of the Big Four firms, he only quipped, quote, we're high on quality. I think we have a good number of good people. When you look at the resources available to the California Board of Accountancy, the comparison between that board and other boards of comparable importance to California's is astonishing. The California Board of Accountancy has a budget of about $10 million. It has 5 investigators. By the way, there was some talk earlier about the trouble filling the investigative spots. That is true. But that is because the Board of Accountancy alone among the Department of Consumer Affairs boards insists that its investigators be licensees. And as a consequence, you have to pay them more if you're going to get a licensee. The State Bar, the Medical Board, you name it, the investigators are not intended to be licensees. And that's part of the reason why there's been this clash, because while we, as you'll see in a moment, support not only the filling the 2 vacancies that persist at the board, but far more investigators, the administration has, not without reason, said, well, wait a minute, if I'm going to up my investigator salaries for this small echelon of people, all these other people aren't going to be real happy. And so that's where we've come across this friction. Anyway, $10 million for the Board of Accountancy. The Medical Board's budget is $41 million. The Contractor State Licensing Board is $48 million. As I said, the Board of Accountancy has 5 line investigators, 1 supervisor, and 1 chief. The Medical Board has 79 investigators. The CSLB has 100. The fees paid by licensees for the board are very low compared to other professions. They pay about $100 a year. $300 a year for a doctor. I believe my own as an attorney is about $400 a year now. The percentage of the overall budget of the board devoted to enforcement is about 44%. It's about 75% for the medical board and 55% for the CSLB. Now, it is true that there are more doctor licensees and there are more contractor licensees than there are accounting licensees. But even if you did the math, the amount of money and budget for the board is nowhere near comparable, licensee by licensee, for any other major board of significance for California that we're aware of. And keep in mind, this is California. Imagine what the comparable enforcement powers, budgets, and resources are available for the Iowa Board of Accountancy or Arkansas or Florida. Also, remember that while it is true that California's board has fewer licensees, it has jurisdiction over these 4 multi-billion-dollar corporations. And the ability of the board, the California board, which, regardless of what the PCAOB or the SEC does, and they have important roles to play, it is still only a board of accountancy that can take away a CPA's license. Still only a board that can do that. It's not a fair fight, in all candor, when the California board goes up against one of the big 4. There was a Los Angeles Times article in July of 2004 that talked specifically about the Orange County case. It took 8 years and $9 million for the State Board of Accountancy to discipline KPMG. Quote, "It was a bruising experience," said Greg Newington, the state's board's chief of enforcement. Quote, "When the other side is an entity the size of a major firm and they can bring legions of attorneys and expert consultants, a little agency like ours feels insignificant." That was reinforced by the board's 2003 Sunset Review Report when they talked about their inability meaningfully to seek and obtain enforcement in any kind of way against the big firms. Quote, "The CBA is a relatively small $11 million entity charged with regulating some of the largest firms in the world." Again, this is the board's own statement to the legislature. "It has the intent and the will to implement the provisions of the newest reforms," referring to the post-Enron reforms. "But budgetary and staffing constraints substantially hamper its ability to respond to the demands of complex cases. At this time, it is certainly not equipped nor positioned to proactively initiate more than one complex matter at a given time without a massive dislocation of resources and attendant delays that would undermine the CBA's enforcement efforts in these other areas." So when we're talking specifically about the companies that do 90% of the audits, when we look at the landscape of the regulators who have the resources to be able to match that, it's hard to find one. It's hard to find one, and it's particularly difficult to find it with the good people at the board who simply don't have the resources to be able to go toe-to-toe with those companies. Likewise, if you look at the laws California laws that sort of orbit around the accountancy profession, you will see less disclosure to the public. We just talked about less enforcement than relate to other comparably important boards. I think fourth, I'd like to take a look at Sarbanes-Oxley and those laws that were enacted post-Enron. And I think the case for why much more is needed was really best made not by us or by some sort of lefty publication, but really by The Economist magazine when it put out some editorials around the time that Sarbanes-Oxley was initially passed. Again, this is The Economist. This is not Mother Jones. First, on the scope of the problem, quote, A continuing series of arrests and regulatory censures of large accounting firms has shown that Andersen was not just one rotten apple, but that the entire barrel was tainted. Quote, so the industry's consolidation would seem to demand, at the least, a much more robust set of regulations governing its behavior. And yet, despite new, quote, independence rules, unquote, barring auditors from providing clients with management consulting or other advice, the Big Four still can and do offer clients lucrative tax planning and other non-audit services. Worryingly, these have continued to grow about as fast as auditing revenue at all four firms. The problem is that the existing independence rules are half measures. It is foolhardy to assume, given recent history, that auditors will remain unswayed by the fat fees paid to them for ancillary services. It's, by the way, what is hinted at by what the, only hinted at, by what the independent auditor for KPMG found about pissing off the client. Continuing, and the rules on rotation merely require the periodic swapping of the senior partner on audit teams, reflecting a naive view that biased people are the issue, not biased firms and incentives. If auditing firms themselves had to be changed every few years, it would go a long way toward making auditors genuinely independent. So I think that there is still some areas that are required in order to boost the watchdog function against the backdrop where our watchdogs are paid by the people they're supposed to be watchdogging. Fifth and finally, I think if I were to identify some things for reform, the first is, notwithstanding the budget climate, you have to look at resources for this board and not just filling the 2 vacancies. If we are going to be serious about providing, on behalf of California consumers, a regulator that is able, in addition to willing, to police these very large firms, it requires many more resources, and at minimum it would require higher licensing fees to pay for them. Second is, I think that against this backdrop, and because states are still the ones that are the last lines of defense in protecting their consumers, we need to be increasingly vigilant about who practices here from other states, to make sure that some of the things that we heard earlier about continuing education and all the good things that the California board is doing, we have to make sure that the people who are coming in are as worthy of the public trust as we would hope they would be. It was a very interesting example when we were doing some research about a bill last year where we found that the SEC had brought a civil action, a fraud action, against several folk in a particular accounting firm in Washington State. One of them was also a California licensee. After piggybacking on the SEC action, the California board revoked the license of the co-conspirator, and that revocation was listed on the California board's website. But when you looked at the other co-conspirators from Washington State, not only were their licenses not revoked, there was no hint that the SEC had taken the action against them that they had taken. So a consumer looking on that website would have no idea that in fact there was this backdrop of problems of SEC enforcement. The third, I think, is, and we've heard a little bit about this from the board, is that the enforcement here can't be complaint-driven because of the disconnect between a consumer seeing their 401k disappear and between that consumer having any idea that there may have been a contributorily negligent CPA firm involved. I think that the board, and I think there's room for legislation here in terms of enforcement priorities like you see in other boards. I think the board needs to be very proactive that when it sees the SEC and when it sees the PCAOB and when it sees civil filings and when it reads stuff in the newspaper like other boards do, that it proactively treat that as if someone had complained. I think we need to take a look at the remaining conflict of interest issues that were not addressed by Sarbanes-Oxley. I think we need to take a look at that when you have an entire firm that admits to criminal wrongdoing, should that firm be able to do business in the state of California? And I think that finally, if I were to exhort the profession to do something, I think the profession spends a lot of time working on its uniform laws that they shop from state to state seeking uniformity. When you look at those laws, you don't see any of these issues addressed. You don't see the minimum number of investigators that are required per 1,000 licensees, or minimum disclosure requirements for disciplinary proceedings or that sort of thing on boards' websites, or minimum requirements for discipline for particular kinds of actions, minimum requirements that would protect consumers, I think, in this environment. I would urge the profession to, in its Model Act, to try and take a hard look at developing uniform standards for those as they develop uniform standards that benefit CPAs. And with that, I'll be happy to answer any questions you may have, Mr. Chairman.
Thank you very much. Mr. Fong, do you have any questions? I want to thank you both for taking the time to offer your perspectives. And what is so illuminating about this process is you taking into consideration information that was generated at the first hearing and then the sorts of things that was presented at this hearing, which makes it real obvious to me that we're going to need a third hearing and may very well need a fourth, depending on how these things sort of tease out. You know, on the one hand, at the first hearing, I think could be fairly characterized as saying that the accountants, certainly with New Century, the claim was that the accountants had a responsibility and obligation that they didn't satisfy, and that that contributed to the financial meltdown. This hearing, I think, can be accurately portrayed as some people said that the financial meltdown was a result of market forces that existed beyond anyone's control and timing issues that sort of all coalesced around a particular window of time that were unforeseeable, and as a consequence, there is no single entity that is responsible. Mixed with some additional testimony that, in fact, there are some obligations and duties that could better be executed. I think the danger in approaching this particular topic of the financial meltdown is when you take the position that there were so many different aspects at play that no one is individually or singularly responsible. It means that there's no accountability for anyone. I don't think that makes sense. It may make sense that there isn't an individual, okay, or an aspect of industry that we can go pin the tail on the donkey and say, we're all happy now, we figured it out, you know, we're never going to have that donkey in this room again. I think it's far more complicated than that. I think there were an awful lot of players who bear some responsibility for getting us to the place where we are now. And I think part of my obligation as chair of this committee is to, as best I can, try to figure out what role disciplines had, what role industries had, what contributions did everyone sort of make, from the homeowner, the borrower, who was overly enthusiastic about claiming how much money they made a month, to the loan originator, who was more than happy to look the other direction because there was a fat fee connected with a subprime loan, to people who just should have known better about how they bundled these instruments. The fact of the matter is that so many of these financial instruments, there was probably 2 people in the world who understood how they worked. And they weren't everywhere else. And people just took it as an article of faith that somehow it was going to be okay. I believe that the increase in the housing market fueled people's expectations that this bubble was going to last forever. I think that there are others who clearly saw that that was foolish, and they saw it years before it came apart. And so I'm just very grateful to members of the accounting profession who have taken the time to come educate me as to this. And I'm very, very grateful for all the panelists, because we had clearly some distinguished and well-accomplished panelists who brought their experience to this committee hearing today to sort of help me, guide me, influence me in a particular direction based upon how they saw their part of the world. We are going to have a third hearing. I think that there are lessons that can be learned from the specific examples of New Century. I mean, if I characterize New Century at the first hearing as patient zero for the financial meltdown, and I think the more that I hear, I don't think it's unfair characterization. I want to talk to people who can walk us through what happened with that company and how the various pieces all fit together to create this unfortunate, trite phrase, perfect storm that has caused such havoc in people's lives. One of the earlier panelists was talking about how they saw their retirement fund, diminish by 40%. And there are, quite frankly, people whose retirement funds have diminished in those kinds of amounts who are never, ever going to be able to make it back, who are not ever going to be able to retire. We'll have to somehow continue to work until they're no longer even physically able to get themselves out of bed. Somewhere, somehow, we will be damned if we don't learn lessons from this to try to create some sort of structure to minimize the harm to innocent people in the futures. And I don't include in my assessment of that those folks who made outrageous amounts of money, because quite frankly, in what I've seen so far about how these instruments were marketed and sold, you didn't really have to be all that smart to make a lot of money in this kind of market. It was really more a question of having access, of being at the table when the deals were done, and that just happened to be luck for a lot of people. It wasn't genius, except for maybe those two guys who created it. It wasn't genius, those folks maybe, but for so many others, it was just about pushing product. And I guess there's a reason why I happen to be chair of banking and finance, and it must be just for this. I want to thank you all for coming. I want to thank you for offering your expertise, and I look forward to seeing you again. We have public comment. Is there an individual here? Mr. Olson. Carl Olson is a CPA. Are you not?
No.
Somebody lied to me. They'll be fired when I get back to my office.
Well, this gives me some objectivity.
Do you have material you want to hand out?
Yes. Here's a statement for everybody and all the kind of the absent members of the committee.
Okay, they'll get them.
Yeah. I appreciate having the time to talk with you. I teach college accounting for places like Cal State Northridge and Moore Park and University of Laverne and so forth at the master's and bachelor's level. I'm active in the American Accounting Association's public interest section. I chair an organization called the Fund for Stock Owners' Rights. We're a nonprofit group that advocates on behalf of investors. And kind of on a personal note, I'm a Navy retiree, and I'm often found at the naval base at Port Hueneme. So I consider myself an honorary constituent of yours.
Yeah, no, you certainly are. You're close enough that I can reach out and touch you if you're down there at Port Hueneme.
Okay. Well, I think the most germane thing is that for the last 2 years, I have attended and participated in the meetings of the Board of Accountancy. And I want to bring you some of those experiences so you can maybe make some policy based upon that. As you know, all of the financial statements of these debacle companies like Countrywide and New Century and AIG and Freddie Mac and Fannie Mae and so forth have all been given clean audit opinions. As we all know, these are all debacle companies. And it turns out that these financial statements were off by, who knows, $1 trillion or something like that. As a matter of fact, I think you might be concerned at the state level that many of these audited financial statements are sitting in the Department of financial institutions or real estate or corporations as though they're for real reports. And I don't know if you ought to rely upon these sort of things. Well, when I teach accounting, and we're all familiar, with annual reports and so forth. And I ask my students, well, Why should you believe these things? You weren't there. You don't know any of this stuff. I don't either myself. I would want somebody to guarantee that these are accurate financial statements. And in fact, that's what CPA auditors do. They, with their opinions, are giving a guarantee, a financial guarantee of the accuracy of these statements. And it's true. You asked the question about do individual stockholders or bondholders over have a standing and a cause of action to sue, and absolutely they do. And they have won hundreds of millions of dollars from many, many cases, including the one that was just mentioned here. You know, County San Mateo has just started up on their $150 million fiasco. And so, yes, they do have a cause of action here. Let me find here. Well, now the question is, how can the CPA auditing industry keep on doing this thing to us for so long? And mainly it's because they have no fear of any significant penalties, real quick. At the federal level, we aren't getting much help. The SEC and the FBI's investigating staffs have been gutted in the last 10 years. You may be well aware of this, and that gives the state a much more important role. So that brings us down to the Board of Accountancy. That's where we want to get to. You were talking about the enforcement staff there. Yes, you can count the enforcement staff on less than 2 hands. And in about 3 weeks, it's going to be on less than 1 hand for 86,000 people. You really have to send a CPA to catch another CPA because it is so intricate and so forth. The good thing about it is that the Board of Accountancy's budget is not an appropriated budget. They don't have to come to you and ask for money. They are funded not only by fees, but also in fines and reimbursed expenses. Several hundreds of thousands of millions of dollars can be raised that way. As a matter of fact, they, in this last year or so, did that with KPMG. But you can help in one respect there because the combination of the legislature and the governor took away $20 million of their fund. It ought to go back to them to be used. In regard to the pay scale, this is again a thing between the legislature and the governor's office that doesn't allow paying that much, and it has also something to do with the negotiated labor contracts as how much you can pay different levels. You ought to let them loose. They asked, how many should you have? You should have at least 100. 7 is just, it's less than pathetic because all they can do is pick on the real small guys that are easy pickings. Now, are they interested in big cases? On their last report, they have one major case. I don't know what it is, but they have one major case. At the last board meeting on the 15th of May, they had a big discussion as to whether they actually wanted to do big cases. And you could listen to it in the enforcement report. And they, after a long discussion, says, no, I don't think we'll pursue big cases because they're just too tough. That's not really heartening here. And I think the last thing I want to report in here is having to do with just the composition of the board. Kind of the 7 to 8 thing in there, it really is the fox watching the chickens. There is no member of the investing public, the users of financial statements, the consumer groups, none of them are there on the board to kind of look after the consumer's interests. So that's in a nutshell what I wanted to deliver here in the way of policy and recommendations, and I look forward to a couple more hearings.
The members of the board are selected by, are those all gubernatorial appointments? Looks like I'm getting some heads back there.
Well, there are 4 of them that come out of the 2 leaders of the 2 houses here. The rest are gubernatorial ones, though I think it was 7 of them have. Yep, 7 out of the 15 have to be.
Somebody want to come up and give me the.
But I guess
somebody who knows this. Let's just fill in the holes. Sure.
The board guys left. But if you look at their staffing thing, they are appointed, by the governor.
Yeah, the question that I asked was with respect to the Board of Accountancy. Whose appointments are they, and what's the proportion?
Well, my recollection is that Mr. Olson is right, that there are 2 appointees from the Speaker, 2 appointees from the Pro Tem. The balance are appointees of the Governor.
Okay.
It is a public member majority. But as Mr. Olson correctly points out, unlike, for example, the Contractor State Licensing Board, where there are qualifications for those
Right.
public members,
Right.
Other than certain conflict of interest qualifications, such as you can't have a family member who's a CPA, you can't have been a lawyer that represents CPAs, there are no sort of affirmative qualifications, no slot for consumers, no slot for investors,
Got it.
no slot, that kind of thing.
Okay. Okay, thank you. Anything else?
Not at this point, but I provide a whole lot of other materials, I think, to your staff, and be more than happy to follow up with it.
All right. Well, thank you very much, Mr. Olson, for taking the time to be with us today. I appreciate it. And with that, let's adjourn. Thank you very much.